Good evening again. So we have welcome to the CPE seminar on New Income Tax Act series number 4. So we have our two sessions today by CA Uttamchand P Jain sir on the topic of TDS and TCS, and CAB Raghav Prasad sir on the topic of assessment procedures. So let's before we get into program, and we have our distinguished speaker CA Uttamchand sir with us. Sir, I request you to kindly occupy the desk, sir. Thank you, sir. So before we officially begin today's program, I request members to rise up for us I Say motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैत
Thank you. Please be seated. So we have our first session by CA Uttamchand P Jain sir. So before we begin, I would like to give a brief intro of our sir. Sir is a fellow chartered accountant in practice since 1996 with over 2 decades of professional experience. He specializes in audit, taxation and bank audits. He has held several key positions in professional bodies, including past president of Association of Chartered Accountants Chennai, and currently serves as management committee member and joint convener at the Chartered Accountants Study Circle Chennai. He also contributed extensively as an editor and editorial board member of professional publications. He is also a professional contributor to ICI publications, and he has co-authored books and play a key role in revising guidance note on tax audit, bank audit and peer review. He is a sought after speaker and faculty, having delivered sessions on audit, taxation and tally across ICI forums, professional bodies and government institutions including CAG, NASIN and ONGC. On behalf of SIC of ICI sir, we welcome you to today's session sir. And I now request CA Hitan Gandhi sir to kindly come to the stage and deliver the memento to our speaker. Thank you, sir. I now kindly request CA Uttamchand P Jain sir to kindly take over the session, sir.
Good evening, everyone. You are learning a new act, and if the energy is so low, it will be very difficult to get into that particular subject, because idu vandu aracha maavu, put it into a new container and given into a new format. There is no major change. You would have heard from various people saying that there is no major change, there is no major change. But then there are certain gaps which have peeped into the entire scenario, which will take you to litigation in future. And you have to know that, and it has to be looked into that particular scenario, because we are restricting ourselves to TDS and TCS. But in one of the meetings which the chairman of the committee which went into the entire bringing into the New Income Tax Act 2025, in an interaction he said, Income Tax Act is a dynamic one. It is ever changing. it cannot be stable, it cannot be fixed, so it has to go on. And you would have seen before the act coming into implementation itself, amendments have come. So the very intention of law was to reduce the amendments, but we don't know what made them to rush through all this, and there are certain gaps which have happened, and those gaps are very, very glaring in certain places. Like for example, they said provisos, explanation, it was to the specific section. But when they redrafted the entire provision, it became a subsection. So when it is becoming a subsection, you should have remembered that it is a part of a section or a previous subsection. So they should have referred to the subsection in that second subsection, because proviso became a subset and it became a subsection. So those kind of errors have creeped into, and they said that the entire law is getting changed because we have section 148, 148A, 148B, 144, 144B, so on and so forth. In 1023C, there were around 23 provisos itself. And that's they wanted to reduce, and they brought in each as a subsection. In doing that, they missed out to change certain things. Like even in the TDS provision, they forgot to write somewhere that it is in this chapter. Instead of saying this chapter, they have said this provision. Now, how can you overcome something which is there, not there in that provision itself? So those kind of issues will be there. But we are more into the practical scenario, how the TDS and TDCS provisions are going to change, how they are made simple, but I don't know whether it will continue to be simple. But one thing is for sure, it has been tabulated, so we can see in one place. Instead of reading every section, we can see in one place all the TDS and TCS, and that's how they have said there are only 3 provisions. There are only 3 provisions they have said, and that's how it is working. But when you see again, in the provision, in the table, there are so many subclauses, and there are many more which are there inside that. We try to do and learn something. On the TDS and the TCS provision, my number of slides will be restricted, and my interaction with you should be much more, because it's not something which I have to give from here, I have to learn from the other side as well. The only reason why I am here is I take the courage to be on the other side. That's the only thing. Otherwise, we are all on the same platform. So whatever views I am going to express here are personal, nothing to do with my firm, nothing to do with SIRC, nothing to do with anyone. All are my personal, and it is to help you to understand the provisions, and you take your calculated risk which you want to take, because I may give you certain things which can be a calculated risk. I strongly believe in this. Knowledge is power. Knowledge shared is power multiplied. I normally give this example to even the classes where I take for students. Wherever I go, I say this: if I have 1 rupee, you have 1 rupee, we exchange. How much we have? 1 rupee each. If I have 1 idea and you have 1 idea, we exchange the idea. How many we have? Not 2, minimum 2. Because it's then the capacity of the person to multiply it. I can use that, in other words, in a different manner and learn much more or use much more. So knowledge is a powerful tool, and what they are trying to do is the 1962 Act, for long it was there. We had difficult and different litigations going on. Even today there are litigations. The Jao Fau case, what has happened to that? Any idea what has happened to that? It has been remitted back to the High Court. The Supreme Court has not decided. The law has got amended. Taking cognizance of that law, they have only remitted it back to the High Court, saying that the petitioners can modify and challenge the constitutional validity of the amendment which has been brought in. So litigation is going to continue. And if the litigation doesn't continue, then we don't have work. So we and the advocates will have work, only the litigation continues. Again, one more development which has happened in between is there is a case filed in the Delhi High Court saying that only advocates can appear for any litigation matter. That matter is pending before the Delhi High Court, and the institute also has intervened into that particular case, and that matter is again there. So with all this background, we have future secured, where we will have more work to do and more work to, and that's the reason why we have to get into a bigger and a new fresh water. So what is the agenda we have? We will unlearn the Income Tax Act 1961, and we have to relearn Income Tax Act 2025. We have to forget about the provisions which we remembered, 194 to 196, all that we have to go for a change, and we have to remember the new act. Then there is a new rule which has come into picture from 1/4/2026. New rules. If there are new rules, there will be new forms. So that also we have to learn. And then we have to learn the structure of the TDS provisions, TDS as well as TCS provisions under the new Income Tax Act 2025. Then we have to read or understand the TDS mapping part 1, where it is relating to certain nature of payments. Then we will learn about the second part, which are again related to some other payments. And then there is the third one, which is the NRI, where a lot of action is presently on, because there is a change in the method in which the TDS relating to immovable property has happened. Then we have to do some certain comparison between the income tax rules and forms. Changes in your form 24Q, 26Q, 27Q, 27UQ and all that statements have gone for a change. Your TAN application form, which was earlier 49B, has gone into new form 134 and 135. Lower deduction, that form number 13 which was there, has now got changed to rule 213 and 128. Then we have that these are the regular forms which we come across on a daily basis. That's what we have covered. Form 15G, 15H for non-deduction of TDS. That is a new single combined form of 121. TDS certificates, form 16, 16A, all that has gone for a change. Now it is 130, 131 and 132. And then we will have the key practical takeaways which will pertain to now filing the returns, and then question answers. Income Tax Act 2025, the TDS and the TCS provision has been consolidated in one particular place. Earlier in 1961 Act, there were 60 plus provision, though they were covering only 194 to 196. Numerically, there were only 4, but then there was subsect in everything, right from 194, the latest one T, R, and all that came into picture. So now that has been all consolidated, and these sections were scattered because there were certain cross references and all that. Even today there are some may have dual impact, like your renting of plant and machinery. Renting of plant and machinery can come under contract and can also come under your 194I, if I am not wrong. But then those provisions are now, we have to forget about 194 and get into the new provisions. All that has been changed, including your 206, the TCS provision. Now there are only 3 sections. Literally there are only 3 sections. One is 392, TDS on salary, which has been kept separately. Earlier also it was separate. Second is 393. All other TDS provisions are coming under that. Everything is coming under that as a table. So it is easier to quickly refer to. Earlier what happened? We used to go and search for the section, then try to read the section, analyze the section. Now there is a table. Just see the 3 parts of the table. You will know what are the terms and conditions, how that deduction has to happen. In that sense, it is simple, it is easier. It is more like a table which can be given to anyone to look into it. Then you have the section 394, where all the TCS has been brought under one section with a small table therein, because the number of deduction in TCS are lesser, as well as TDS is a lengthier one. TCS is on TCS is something you collect and TDS is something you deduct. So there are certain items which may or may not be income for the other party. When you collect, it is on your sales. Now whether legally correct? How many of you have read section 199 in the erstwhile 61 Act? We will go through that. We will try to understand how the law has been framed by going beyond the Act itself. It has gone beyond the Act, but then no one has to, who has to challenge that? That is the problem. So whatever the Income Tax Act 2025 amendment which has been made, their corresponding effect was rules. We didn't know whether the rules will come into place, whether it will be available on time, whether utility is available on time, not available. So it all depends on how the utilities are going to be built up, and the present scenario in which we are. Utility goes beyond the rules, rules goes beyond the law, and the law goes beyond the constitution. And that's how the entire framework is happening, because we cannot blame the department for doing this, because it is how I communicate. Suppose I want a software to work in a particular manner, or if I have to create an AI app, what command I give, based on that the reply will come out, correct? So what I feed the person who is writing the software, based on that the report will come out, or the app will be prepared, or the utility will be prepared. But it has to be tested. And then who are the testing party? In today's scenario, who are the testing party? We the chartered accountants are the testing party, because assessee is also not bothered. He says, I have given you the data, you file my return. That's all. That's how it works. But then the testing is the failure and the gap which is there. The gap is between the person who wants to implement and the person who is using to implement. There's a huge gap in between. That gap has to be filled up, and if that filled up, then this will become a very, very simple act. Earlier there were only 134 rules. Rule number 134 was the last rule as per the rule, but actual rules were 500 plus. Now it is replaced by Income Tax Rules 2026. It was notified and it has come into effect from 1/4. It has come into effect from 1/4/2026, and they have said that they will come out with the utilities as well, and utilities are coming one by one. The income tax returns has been notified, but the forms have been notified, utility has not yet come. And after the notification of the return forms, amendment to the notification also came. So that's how it works, because to err is human. So the number of rules now is 333. 333 sequentially numbered. Will it continue to be sequentially numbered? Why not? Already you have seen in income tax. Even before the Income Tax Act was implemented, there is an amendment in the 2026 budget wherein one of the section has an A. Already it is there. Particularly for your nullifying the JAW FOW case. And it is effective from 1st April 2026. If you see the number of pages, I am not getting into the pages which will come as a print in a income tax rules or by taxman or so. It is the department website which has given you the rules to be downloaded. In many pages, one page will be only few lines and then there will be nothing on that page, because they are trying to give every new rule on a fresh page. So that number of pages is 648 and now it is 410. So it is simplified. Why? Because there were many forms and many rules which were redundant, that has been removed. So up to 31st March 2026, that is financial year 25-26, you have to say assessment year. And your 1961 Act and the rules thereto will be fully applicable. So there were 511 rules. In the earlier slide I had said 500 plus. Now exactly 511 rules, 399 forms in force. How many we were using? Very few out of that. On a regular basis, very few. But then these were the forms. For example, I don't know how many of you would have ever used it. When the AO issues you a notice saying that you are supposed to pay advance tax this much, kindly pay. And you are supposed to give a response to that, saying that no, I need not pay that much, I have to pay this much. There were forms for that. There were forms where the AO also should have used a particular form number, and the subsequent form number was for the assessee to reply, to respond. That was the procedure, but no one was following. Only letter will come. You are supposed to pay the advance tax, don't pay. You have not paid, kindly pay. So that kind of a scenario, there were many forms like that. TDS sections were 192 to 196. So if you have to count 92, 93, 94, 95, 96, 6 sections. And in TCS 206. However, it is going to change everywhere, and it was chapter 17B for all TDS provisions and chapter 17BB. I am not correct, I think it is 17BB for TCS. Each section had their own conditions, had their own lengthy provisions, where they will be talking about many more things in that particular section itself. The limits, everything will be under the same section itself. Now it is going for a change. From April 1, 2026, you have to remember as a tax year. So there will be a confusion for 1 year. Assessment year will also be there. Tax year will also be there. And the term will be 2026-27. So you should not get confused between that's a major change which has happened. So whenever you are making a tax payment or a TDS payment, even when you go to the website, it will ask you and it will modify accordingly. So that's the control they have made it in the portal, where you don't take the wrong year or payment done. Now there can be a practical issue here. I have paid the challan. We had earlier the problem, no? We paid the challan, unconsumed challan, I can use it next year. Correct? Now there is a question mark which is there, which is yet to be settled. If I have unconsumed challan for assessment year 26-27, can I use it in tax year 26-27? There is no clarity as of now. Only the time will tell whether I will be able to do it, how it will be done, because the challans will contain the payment code, the section, everything differently. So that kind of a issue will be there. From 1/4/2026, for the transactions, the new Income Tax Act 2025 will apply and the new Income Tax Rules 2026 will apply. Now the number of sections are reduced to 333 and 190 forms, 190 forms. Drastic reduction in the number of forms, because some places the forms have been combined. You don't have a multiple form, there is a combined form like 15G, 15H, there is a combined form 141. Sections, it is from 392 to 397. However, there is no policy change. Though they have tried to copy paste as is where is, it's more like a word file, find replace, notwithstanding anything contained, irrespective. Just change it. Why the change? Will the change have an impact? Only time will tell. Because notwithstanding anything contained has been tested in the court of law, whereas irrespective has not been tested. So there will be again second round of testing which will happen to the irrespective. And there is a new trend now. Not just notwithstanding anything contained in any other section, notwithstanding anything contained under any judgment by any court. I don't know why. Because once you amend the law, that means the judgment is nullified. Once you amend the law is amended, the amended law will apply. If there is any judgment contrary to the amended law, that is not applicable. Why should you write that? And then amendment to amendment. They said notwithstanding anything contained in any other provision and notwithstanding anything contained in any judgment. That is the amendment which they brought in to nullify DIN case. The challenge to the DIN number, that they have brought in the amendment. So there are different ways in which the amendments are coming, and that also will have the impact. But as of now, there is no policy change on the face of it, only structural reorganization, renumbering, restating, simplifying the presentation. Section numbers have gone for a change, form numbers have gone for a change. So you have to now remember old form number, new form number. Until your litigations are all completed in the old form number, old section, even that has to be remembered. Once everything is solved, you don't have any case, then you can think of. But then for your interpretation, you may have to go back and see those sections and those forms. So key principle against this is no change in the TDS policy rates, only numbering of sections, consolidation of forms and simplification of language. And while simplifying, there are some errors as well. So we have moved from chapter 17 to chapter 19 now. Chapter wise, 2 chapters forward. In the Income Tax Act 1961, there was chapter 17B relating to TDS, chapter 17BB relating to TCS. And now in Income Tax 2025, you have chapter 19. So you had sections 192 to 196D relating to deductions of tax, and then you had 206C for TCS collection. As we go forward, we will try to get into the section and try to read and try to find out what could be the problems therein, how it has to be read, and how it can be interpreted in future. Each section was self-contained with its own limitations which were given, exemptions which were given, and the procedures and prescribed forms which were given. You had multiple rules, rule 28, 28A, 28AB, 29, 37G, 37H, and it were all not sequential, it were scattered somewhere. And then you had also the separate form for lower deduction, form 13, form 15C, 15D, 15G, 15H, 49A, 49B, so on and so forth. 49A was for PAN, 49B for TAN, and that's how it was there. Now there is a change which is very, very specific. 392 only for salary, 392, 393 other than salary, all TDS other than salary is covered there. Resident, non-resident, everything is under that. 394 is specifically covering TCS provision of the 206. Entire thing is covered in 394. And then you have 395 which talks about certificate for lower deduction, non-deduction, that is 15G, 15H or your 197 erstwhile, all that is covered under 395. And then you have section 396, which is talking about your TAN, PAN, non-availability of PAN, higher rate of tax, then your due dates, what are the TDS statements which you have to file, when you have to file, all tabulated. And because when they tabulate, it becomes easier. When they want to add something, you have to only add in the table. If they want to delete something, you have to only delete that serial number in that particular table. If they want to amend, they have to replace on the table. So, the section is not touched. If the rates are changed, only the rate will change. They will say this is replaced by this, that is it. It becomes simpler instead of entire thing writing, because otherwise what they have to do is they have to write and read the entire thing and see to it that it is not contradicting when they make a changes. And 397 talks about the consequences of failure, the interest, penalty and all that is covered in 397. Earlier your sections were somewhere else. For non-compliance, it was somewhere else. It was under 270, 271. Now it is under the same provision. In other words, it is consolidated, all related to TDS in one place. Everything is one place, only prosecution will be kept separately. Everything is one place. As we said earlier, no change in policy, only structural presentation is there. It is simplified in that manner. And not the other way around, saying that businessman made easy by reducing the TDS. No. TDS is increasing day by day, and you have one which is the latest one which is haunting everyone, which is that 194T, remuneration to partners. Sir, my salary itself is 12 lakhs, tax is not liable to be paid, 1,20,000 TDS deducted, cash flow affected. Can I go for lower deduction? Can I go for lower deduction? From 1,426 you can. But I am asking for 31,326. No option. No option. Your cash is going to be caught there. You wait till the refund comes. And when the refund will come, it all depends on your luck. You file your return, within 1 hour your return is processed, refund is ready for processing, refund is also processed. Your refund is higher, we don't know how it is going to be done. So, I am just trying to get into some sections, then I will come back to the charts and the presentation relating to the charts, but the section very funnily worded. If you start with, it says the tax on income, the tax on income. So, the word is income shall be payable as per this chapter by way of deduction. So, there is a combination of income to deduction. Now, income in whose hand? Income in whose hand is the question. And that is the reason why they are saying that TCS is also applicable. Income in the other person's hand. Now, whether the transaction is per se fully income? No. If you read the erstwhile 195, any sum which is taxable as an income, then TDS will apply. And if you are not able to decide how much is to be deducted, then what you do? You make an application with the assessing officer saying that determine my tax. A lot of discussions used to happen on the property. The NRI sells the property. So, TDS has to be deducted on gross, net or net of net. As a deductor, what do you do? On the gross. Now, if you read the section, it says any sum which is the income. Is the gross income? No. But who can determine the income? Only the assessing officer. So, they had the provision under that 194 subclause 2 and 3, where they said that either the deductor can make an application with the AO and ask him how much to be deducted, or the deductee can make an application and get a exact amount what is taxable, and at that time you produce what? The sale deed, the purchase deed, cost of improvement details, and so on and so forth. And if you are going to invest somewhere, you take an undertaking, you give the undertaking there, and everything you can decide based on that. The AO may take a call saying that maybe when you compute it is coming as 100, and he may say no, 120 may be deducted. Whatever he decides has to be deducted. Now that was the scenario. Then came the scenarios where they said, I will deduct fully, I don't want to get into that process because I have to go back, I have to fly back. So that kind of a scenario came in. And then there were other issues which were coming in, whether I should have a TAN. I am an individual, I don't have any other transaction, so they have simplified now, no TAN is required. But the problem is the process is not in place. So how will you deal with it? There are a lot of issues which are there. So we have to find practical solution. Now the problem here is it says tax on income shall be deducted. And it also goes on to say, if you read the fifth subclause where it says shall be treated as payment of tax on behalf of the person from whose income such tax has been deducted. Now that may not be an income at all. For example, cash withdrawal. Cash withdrawal from bank. Is it your income? But just to track the transaction, the TDS provision has been brought in. So something which are ultra vires the act. It talks about tax on income. So that particular point will always be a case for litigation. All that will come to your help only when there is something which is penalty, saying that you are not deducted, you are penalized. At that time you can argue on those lines, but you will get the reprieve only in the maybe at the High Court level or at the Supreme Court level. It's a very, very difficult proposition, but then that is what is there. 390 subclause 3, again worded which is very, very difficult, where any person including the principal officer of the company who is required to deduct any sum as per the provisions of this act are referred to in 392 2A. Now just concentrate on the first part, who is required to deduct any sum as per the provisions of this act. So is there anything which is beyond the chapter 19? Because they are using the word as per the provisions of this act, not as per the provisions of this chapter. It's wider. Referred to in section 392 2A, that is very clear, employer, because that is on salary, does not deduct, or after so deducting fails to pay, or does not pay the whole or any part of the tax as required under this act, and where the assessee has also failed to pay such tax directly. So dual now. Then such person shall, apart from any other consequences that he may incur, be deemed to be an assessee in default within the meaning of section 398 subclause 1 in respect of such tax. So there is a reprieve if the other person has already paid the tax. I have had to deduct for a particular person, I have not deducted, and that person has already paid. In that case, I may not be considered to be an assessee in default. Is there any other consequences? Because they have said very clearly, apart from any other consequences that he may incur. Interest. So for the period from which you ought to have deducted till the period in which he has paid, he has remitted, the entire interest has to be paid. This is replica of nothing but section 200. It has come here. But the issue is when they are writing something, they forget that that has to be changed. Because then want to simplify, don't want to get into litigation, then they should have said under this chapter, not under these provisions of this act. Under this chapter would have sufficed, but it is going beyond that. They are saying as per the provisions of this section. 392 subclause 4. The person responsible for making the payment under subsection 1 shall take into account the following particulars furnished by the assessee at his option in such form, verified in such manner as may be prescribed for the purpose of making deduction under the said subsection, and such particulars shall have the impact of increasing or decreasing the tax to be deducted. The person responsible shall take into account the following particulars furnished by the assessee. Is there a definition of assessee? Assessee is normally what we call, as a chartered accountant we say assessee. But under the Income Tax Act, is there a word assessee? Is there a word person? The word is person. Simplified but not simplified. They should have used the word person. They have used the word assessee. And this is particularly for your salary deduction. I am not able to understand whether you have understood there is a issue there which is binding on the employer. Any income under the head salaries due or received by the assessee from any other employer or employers during the tax period. So this was there earlier also. If he says that I have received salary from X this much, I have to include it and try to find out what is the estimated income and deduct tax. This was there earlier also. Everything was there earlier. Any relief allowable under section 157 where the assessee being a government servant or employee in a company, cooperative society, local authorities, university, institution, and is entitled to such relief. Don't ask me what is 157. I have to just refer to the section now because we have to update ourselves. It is, I think if it is not wrong, all the perquisite which they get, no gratuity and all that, exempted income in that kind of a scenario. Any loss under the head income from house property for the same tax year. Income from house property for the same tax year. If it is carry forward, no. Any income chargeable under any other head of income not being a loss under any such head other than the loss specified in subclause 3 for the same tax year. In other words, I cannot take cognizance of any losses, only profits I can do. There is some form earlier, some 12B something, where the employer will give the details saying these are my, and then you had something called form 12BB. So when you collect your form 12BB, go back and read the new form number. If you want, I can just find out and tell you. But then that form has to be collected when? When your deduction starts? April month. As soon as April is end, you want to disperse your salary, TDS provision gets kicked in. So if at all you want to take cognizance of the deductions which they want to claim, when you have to take the details? Now, in April, but they wouldn't have invested. All are prospective. So initially you have to take as an initial form, take cognizance of the initial form, and that itself you have to say that at the year end you have to produce, otherwise normally they will say that by March 15 you produce. If you don't produce, entire thing will be deducted in the month of March. It will be deemed that you don't have investments or the claims which you have said earlier you will get it. Correct? So that kind of a scenario, because no one gives you a cognizance. No? Say suppose you have to collect the documents from them. Then what is the first thing which you have to collect from them? What is the default scheme? New scheme. In the new scheme, do you have deductions? So, first you have to take saying that I am opting out. So, your form has to be designed, because the ready-made forms which are there, which is given by them, does not have all this. So, you have to modify and keep additional information with you and take cognizance only of those and then try to work on it. Otherwise, you will be violating here and you will become assessee in default, with other consequences of disallowance because non-deduction that will follow separately. Again, there are a lot of questions saying that in case of a salary, how will I disallow? In others, I know some percentage disallow. In salary, how will I do it? So, it is a practical problem. Some will say do it proportionately. There are judgments also saying that do proportionately. Say for example, I have to deduct at 2%, but I have deducted 1%. Now, if you strictly interpret, because it is a penal provision, disallowance of expenditure for non-deduction is a penal provision, it has to be strictly adhered to. If you read that section, it says deducted but not remitted or not deducted. Have you deducted? Yes, but percentage wrong. Deducted or not? Deducted. Remitted? Yes. In that kind of a scenario, that kind of an argument can come saying that I have already deducted. But there are judgments which are saying that you will be having proportionate disallowances. Now, when it comes to salary, how will you disallow? There are no judgments as of now, as far as salary is concerned. How will you disallow? So, you have to find a practical solution. So, you can, and in your tax audit report, how will you report it? Because once you say not deducted, it should get disallowed. And if you do not get disallow, you will get, I am just remembering the old section as far as assessment is concerned, because assessment will all start after the tax year. So, the assessment for 26-27, it will come under 143(1)(a) intimation, where they will say that this is said by the auditor in the tax audit report, you have not said in the return. So, this is the adjustment, 30 days time, respond. How will you respond? So, if you mention it or fill up the form 3CD in such a way that you say there is a disallowance, then there is a problem. If you do not say, then you are COP at risk. So, you have to find a midway. If anyone wants a midway answer, once I come down, I can give you. From the dais, I cannot give that. The tax deductible from the salary shall not be reduced in any case except for the following: loss and tax deducted collected as per the other provisions of this chapter. So, if I have salary deduction, say 100, and I had vehicle purchase where I have a TCS that covers my TDS deduction, then that can be set off. And if there is excess, nothing to be done. If there is short, only the short payment should be deducted and remitted. That is the crux of this particular subclause. At whose option? At assessee's option. So, if the employee says, this is the document, you have to, I say I will not accept. I can't do you all, I will not get into all this. Like for example, they say, no, I am taking a housing loan, and the housing loan companies, they says that I want to get it deducted and remitted by the employer directly to me. The employer may say, no, I will not get into all this. Let it come to your account, from your account let it go. I do not want to get into it. He has an option to say no, but here he has no option. If the assessee says that these are my income, please include and deduct TDS, then the employer shall take. So, it is a shall. So, he does not have an option saying no, I will not do all this. Like for example, your EPF. EPF, employer's contribution is fixed. Employee may say, I would like to contribute more. Possible. There it's optional, because I may have an agreement saying that I will not do all this. I will not get into all this. But here it is not possible. You have to. You don't have an option. You have to agree and you have to deduct, include it and deduct TDS. Now let us get back to any other section you want specifically, we can go into it. Any section, anything which is there. Otherwise, I am just getting into the comparison between the old act, new form, old form, and once these 3 slides are over, we will get into interaction again. Salary has been bifurcated into 3 now. Earlier it was only 2, now it is 3. Salary, government, non-union. What do you mean by that? State government separate. Rombo Sodapal. So we will keep them separately and try to understand separately. Salary, non-government employees. So all private sectors. Salary, Indian government employees. This is the bifurcation which has been done, which was not there in the erstwhile law. So 192 is the provision for all the 3 earlier, and now it is 392(1) and the bifurcation within that 392(1). What is the rate at which it has to deduct? Other respective slab rate based on the income which is there. The earlier form was 24Q, now the new form is 138. It's a combined form for all the employees. That's the same form 138. There you select the drop down, whether it is a government, non-government or other than union. The old code, which was not relevant, they said, but still the code was there. Hope you are with me. This code was not relevant. It was relevant to certain time and thereafter they said it is not relevant. Crisscross, you can adjust the challan. Now they have given further code now, 1001, 1002, 1003. That is for their internal purpose. How much is the collection based on each category of employees they want to know. Earlier they used to get it from company other than company, corporate other than corporate, non-corporate. That bifurcation is still there. Along with this, this bifurcation is also there. Then you have interest on securities, section 193. Now it is 393 subclause 1, 5 subclause 1. And it is saying rate in force, 26Q has become 140. Old code was 193. Now the new code is 1019. So you have to remember all these codes and write in your challans. I don't know. It has to be tested now in the month of April when you are going to file the TDS challan, payment of TDS challan, what is deducted in the April month. This will come into picture. At that time, does it go without code or it is compulsory is to be seen. Because earlier it was not compulsory. You can go without giving the code. Dividend, there is no bifurcation. Any dividend, whether it is deemed dividend, otherwise, any dividend, 194. Now it is 393, subclause 1, table 7, 10%. Again, the forms are same. I have a doubt whether the old code is correct. Earlier they had some 94 and then they had 94A, 94C, so on and so forth. Dividend, business trust unit, which is a separate entity, pass-through entity. In that case, it is 194. Now it is 393, subclause 1, 4, 2, 10%. Then you have rent, plant and machinery, equipment, 194H, sorry, 194I. Now it is 394, 393, 1, 2, subclause 2. The sequence in which it was there earlier and the sequence now they have modified. It is not in the same sequence. Earlier it was 192, 193, interest other than interest on securities 194A. That's how it was. Now it has not gone, nor it is alphabetical. Rent has come on top. Rent has come as second item. Rent, land and building, again it is 393. Now land and building is 10%. The rates are same. Nowadays 1009. Rent, REIT units, now they have put it separately. Code number as 1016. Professional fees 194J, 10%, 26Q. Now it is 1027. Technical fee services, call centers 1026. Contractors, earlier it was 194C, now it is 393(1), subclause 6. It is code number 1023 and 1024. Contracts, individual HUF, others other than individual HUF, that 1% and 2%. Commission, brokerage, insurance 2%, there is a separate code 1005, and other than insurance there is a separate code 1006. Lottery ticket 194G, 2%, now it is 1063. Partnership 194T, now it is 393 subclause 3 table 7, 2%, 1067. Interest, senior citizen 10%, rate is all 10%, but they have bifurcated between senior citizen, others and non-securities, and the code numbers are 1020, 1021, 1022. Purchase of goods 194Q, 393, 26Q, 0.1%, and now it is 1031. And finally, the benefit perquisites which are convertible into value and TDS has to be deducted, that is 194R, 10%, and it is 1033 and 1034. The intention seems to be to find out how much is paid under which category, and then comes the non-resident. For non-resident it was 27Q, now it is form number 144. Payment of other sums to non-resident, section 195 has now become 393 subclause 2 serial number 17. They are saying it is as per the Finance Act or DTAA. 27Q and form number was section was 195, that is code number. Now the code number is 1057, and if you see here, these forms are all 1020, 34 and all that. Now it has gone into 1057, separate number far ahead of other numbers. Interest by offshore banking units to NR or non-resident ordinary resident 194 LB, now it is 5% and the code is 1044. Offshore units code is there is no separate code for that, there is only section which has been given. Income of FIIs from securities, again there is no separate code, only the form number is notified. So key notes for non-resident TDS: rate as per part 2 of first schedule of Finance Act or lower of DTAA with form number 41. What is this form number 41? How many of you are issuing 15 CB CA? For 15 CB, what is the form required if I am going to get into DTAA? There was a form required, that is called form 10F. That is what is now form 41. Yes, sir? But now there is a change. That is the reason why I am stopping here. There is a change. Now PAN is a must. In form 41, PAN is required. Lower deduction, payee may apply under 395, now using new form 128 consolidated under rule 213. I am not aware whether the payer can also apply, because earlier payer can also apply. It was there under section 195 itself. Form to be used was same. It was not under 197. They have tried to consolidate. I am not sure, I have not gone deep into it, but that issue is still there. So, the merged forms or the forms, various forms or rules which are there under important TDS rules and forms. I will share the PPT. Hope the organizers will circulate with the delegates who are attending today. Key changes in the income tax rules. Separate rules 31A TDS and 31AA merged into single rule. There is no separate rule for that. TDS return due date remains the same. There is no change in that. What is the due date? For the month of, for the fourth quarter is 31st May. For balance, 15 days. And when the form TDS certificate has to be issued? Within 15 days from the due date of filing return, you have to issue the TDS certificate. Non-issuing of TDS certificate can also land you in trouble. So, whether you issue or not, how the department will come to know? You have not downloaded. If you have not downloaded, you are prone to penal provisions. So, you have to have the habit of downloading. So, you have to have reminder for client, reminder for yourself, saying that this work has to be completed. Rule 33, superannuation funds also merged with Rule 219. So, all the rules which are relating to salary merged into one. Rule number 208, senior citizen pension interest TDS declaration, again that has changed. Paper filing, NSDL form 27A. We used to take a printout, then go to NSDL, give the file. So, what does it mean? So, is that filing with TIN FC is gone? Is it so? No, it is still there, but then paper is not required, OTP is required. So, OTP is based or DSC based filing is come. Correction statement for financial year 18-19 to 23-24 Q3 allowed till 31/3/2026. So, time lapsed. So, any corrections for these financial years you will not be able to do. So, if there are some issues, you have to only approach the EAO, otherwise go to the High Court, natural justice, get a direction and get it done. Very, very costly. And under the new Income Tax Act 2025, correction is allowed only up to 2 years from the tax year to which the TDS return pertains. So, for some quarters you may get a longer time, for some quarters you will get a shorter time. Specific form changes. Form number 138 has 3 annexures: quarterly TDS, salary breakup, senior citizen pension. All 3 breakups have to be given. It is very similar to your Part A, Part B. Earlier it was Part A, Part B. Now it is 3 annexures. Form number 140 and 144, which is for 26Q and 27Q, has same Part A, Part B annexure structure as before. Nothing, no change, major change except the nomenclature. But only when the utility comes, we will come to know what are the changes which are hidden under the carpet. Total tax including surcharge and cess as one figure, no need to give any separate breakup hereinafter. PAN of authorized signatory now mandatory. Earlier it was not that mandatory, but now it is mandatory. Challan serial number only referenced against deductee, not full challan details. Earlier you had to give the full challan details to map it. Now it is only the challan serial number. 26QB, 26QC, 26QD, 26QE all merged into one form 141. Form number 138, annexure 2. Entertainment allowance deduction column has been removed because there is no more allowable. Deduction under 80C, 80CCC, 80CCD, single column under 123. No separate columns, no separate breakups are required to be given. However, if you are going to be the employer, you have to retain the documents with you. If the department asks for the documents, you have to produce the documents, because otherwise you will be deducting lower because you have not collected the document but you have allowed the deduction. In other words, you get into the shoes of an assessing officer for a limited purpose. Form number 140, 26Q, deductive reference number and deductive code 0102, all that is removed now. A separate column for glossing up is allowed only as yes, no. Lower deduction, Rule 28 is a new rule. Application seeking certificate for lower deduction or nil deduction or tax, the erstwhile Form 13, that is what is the rule new. Rule 28 AA, these are all old rules. Issue of certificate under lower and all this is combined into one rule called 213. Rule 28A, what certificate the AO has to issue. Rule 28AB, issue of nil certificate to the charitable trust and NPOs. Rule 29, issue of certificate for dividend payments. Rule 37G, application seeking collection of TCS at lower rate or nil rate. 37H, all these 6 rules have been merged into one single rule, rule number 213, and there's a new form called 128. The old form 13 is the particular replacement. Till what time? 6 o'clock. Okay. Expanded coverage and NPO relaxation which has happened. New payments now eligible for lower deduction or till nil TDS deduction applications. The application was permitted only for specified payments. Under Rule 213, now you can do for all payments, and that's how the 194T is also getting covered. Payment to partners is also covered under. Earlier there was specific restriction, only section 193, 194A, and they were trying to do every time, and every time they used to add one more section and they may forget in some places. Now they have simplified and made saying that all deductions I can go for lower deduction. Purchase of immovable property, rent by individuals, HUF, interest on ECBs, perquisites, payment to partners to firms, these were specifically outside earlier. Now they have been brought inside. One of the conditions for the NPO was the trust must have filed the return of income for all prior years before the due date. All prior before the due date. That was the condition. Now this is all years has been reduced to 4 years. This is natural justice, because you can't say that you have to file all. If you have done error 10 years back, you will be punished today also. So last 4 years if you are regular, then you can apply for. So this is a significant relaxation and welcome change which has come for particularly NPOs, because NPOs are run by people who may not be that educated, that informed, and that's the reason why it has happened. New form 128 vis-a-vis the old form 13, that is the lower deduction. The key changes are tax return requirement not clearly specified. Now new form 4 years. Return details, basic filing details. Now they are saying acknowledgement number, filing date, taxable income, tax liability. Very, very specific questions are asked. Pending return, due date not expired, computation of income to be submitted. That's what we used to do. In the form 13 we used to say expected return of statement of computation of total income. That same continues before, even now. Scope of payment, specified payments only earlier. As we said, some sections were out. Now all TDS applicable sections you can make an application, even TCS application we can make. Non-profit organization, very clear, last 4 years. TAN application, there is a change in TAN application as well. All entities, government, non-government, everything into one form. But today I try to do an amendment to my own PAN data. When I gone for online and try to do it, there was no 134 and all that. They said CR1, CR2. I don't know what is CR1, CR2, which is not there in the Act. That was only for correction, because I already have a PAN. I wanted to do a correction, I wanted to try a test before I come to this session. I did for myself. And they were saying CR1, CR2. I had done through UTI. And then they said, do online, digital or paper. Either paperless or paper. When I try to do paperless, it says your name doesn't match with your Aadhaar. When you do with paper, matches. It cannot be processed. It threw out, it took the money and threw out. I don't know whether refund will come or not. Amount is not huge, so 107 rupees doesn't matter. So we tried this. So we have to be very careful how it is there. And if I am not wrong, UTI office is in Saidapet, Gindi Industrial Estate. You can physically hand over the document and get an acknowledgement and also try to get this. So that are changes which are there, but we don't know how the utilities are going to work. Now new form 134 for government and 135 for non-government, and these are the details which are asked. Earlier it used to be 1 month. Now 1 month is calendar month or 30 days. Now it is very clear, 30 days. So 15G, 15H, many of you would have done bank audit. Yes? You would have seen 15G, 15H. What do you have to do with 15G, 15H? What we are supposed to do? We are supposed to file online and generate unique number, and that unique number should have been mentioned in your 26Q. Now sitting at the branch where it is centralized filing of TDS, how do you go about? And when you called for and test checked it, you would have found that it has only the FD number, the account number, nothing else, only signed. And if you see the form 15G, there is part A and part B. Let us not get in deep into it because time is running out. So 15G and 15H, this is the change which has been brought in. Aadhaar as an alternate to PAN is removed. Now you can't say that I will give Aadhaar and I will give 15G. No. Either you give the PAN number or you give the form saying that I am not assessed to tax. And the declaration requiring the year in which the recipient was last assessed to tax is no longer required. New form 130, 131, 132, 130 and 131 of the erstwhile rule is very, very interesting. Please go back and read those rules 130 and 131, because there are many forms. Again, I have to go deep into it. Whether these forms are updated, not updated, we don't know. How many of you filed tax audit report online? Everyone, including me. Which rule says me to file online? If you read the tax audit, we will talk about the erstwhile law, then we will replace the sections when we go back to office. Because now replacing this memory has to take time. 44AB is the provision which says tax audit. Yes. And what does 44AB say? The assessee shall obtain and furnish the audit report in such prescribed form with such prescribed particulars within 1 month before the due date of filing the return. I am not going to specific section saying that 139(1) and all that. Now what is the rule? Rule is 6G. So 6G very clearly says the information has to be provided as per the form prescribed, which is form 3CD, 3CA, 3CB and 3CD. Nowhere it says you have to file online. Nowhere it says. Now if you read rule 12, in that there is a proviso. Provided further that all the forms, audit report forms, including your form 10, all the forms including 3CA, 3CB, 3CD wherever the audit reports are to be certified, 15 CB and all that, Form 3 CA and all that, has to be digitally online filed. Now, if we read the starting para of Rule 12, it talks about Section 139. So, it is relating to return. In the return, they are talking about audit report. So, technically, online filing is not authorized. But we have been filing because we have to survive. If I don't say I will not file audit report, I will not get audit fees. So simple. And then it is normal that the SC says I don't want litigation. And it is presumed that it should not. So then you file it. Because if you read the form, there are a lot of differences which are there. So now new form 16. If you see, there is Part A, Part B, Part C, Annexure 1, Part C, Annexure 2. So Part A, very simple what it was there earlier, basic details. Part B, now it is saying quarter-wise details of tax deducted and payment made. This was also there earlier. Part C, computation of income and tax liability. This was the erstwhile Part B there. Breakup of salary, what was the tax deducted, how it was remitted. And then Part C, Annexure 2 is relating to computation of specified senior citizens. This is how the Form 130, that new Form 16 is stated. And then Form 131 is 16A, 132 is 16B, and 132 is same for 16C and 16D. Common changes in Form 130, 131 and 132. Average rate of tax deduction each quarter to be furnished. Rule 215 governs all salary and non-salary TDS was separate rules earlier. Now it is combined. Now consolidated Form 16B, 16C and 16D into one form. No change in Rule 215 vis-a-vis Rule 31 and 37, that is the structural changes only in the language, simplified language, nothing is there. Deductee reference number, employee reference number, that was required earlier, now it is not required. Aadhaar has been removed, no more Aadhaar reliance. Jurisdiction details of the deductors removed from certificate. Deductors jurisdiction details are not required because now it is faceless. So these are the practical key takeaways. I will not get too much into it. So we will get into interaction. If there are any questions, let's interact and enrich because it's already 6:05. I am already encroaching into the next speaker who has come well before time. Thank you very much for the opportunity. Thank you so much. I brought my act also together, so if you have any query, I am ready. Thank you. Just let everyone be enriched.
With respect to 194T, partner is regularly drawing an amount. But we
194T.
194T. But we hadn't, in the books of accounts, we hadn't provided remuneration. Only at the year end, based on the profit, we will fix it up. Now, whether the debits which he had drawn, will it tantamount to non-deduction or will 194T will attract?
Two answers. One answer, simple, straightforward, no litigation, deduction.
Okay.
That is a simple answer. But at the time of withdrawal, was it a remuneration?
No.
How will you prove it?
So that's what regularly used to draw apart earlier years.
No. How will you prove it?
Okay.
Document you have to produce. You cannot say that I was doing like this, sir, I will be doing like this. I never crossed my signal. That cannot be a reason. You have to have a documentary evidence for that. So your partnership deed should specifically say that you will be entitled to remuneration only at the year end. Your deed has to go for a change and the deed has to be modified in such a way that you are out of this particular withdrawal on regular basis. If your remuneration clause says that you will be paid on monthly basis,
Yes.
no option. If your remuneration says whatever you have withdrawn will be first considered against remuneration, gone. If you say that whether you withdraw or don't withdraw, you entitled to your remuneration only on the fag end of the assessment year or fag end of the financial year, where it will be computed and credited to your account, and that can be adjusted whichever way. That's a book entry. So I'll say my current account, and I can debit to current account, I can debit to capital account, doesn't make difference.
So deed
That's
deed has to be very clear enough.
Deed has to be all the documents. Now, normally my screen goes for a still, you'll know. Only documents can speak, you cannot speak. Your document has to speak. You saying that no sir, I was all doing that, will not help you. As you go forward, because it's faceless, so we don't know what is the thought process on the other side. Whatever may be this case, but it is better that you have your document strongly worded, so that, say for example, interest also should be credited only at the year end. So TDS will come only at the year end. But I can withdraw. So it should not be considered as withdrawal against interest. I may have a right to withdraw, that's all. That's a normal right.
Okay, to establish that, the deed has to be very specific.
The deed has to be very specifically stating that you will be entitled to receive the remuneration only at the year end based on the computation done, and it can be even linked to your 40A, erstwhile section 40B, or the new provision which is there.
This being the first year, just I want to make this clarification.
This being not the first year, sir. First year is already over.
For the year end.
First year is already over, so you should have modified the deed earlier itself.
Yeah.
So he is well within his right to withdraw. So how can the assessing officer claim that this is his remuneration?
Where you are going to put the debit and credits?
The capital account.
Same account or current account and capital account, two different accounts. Now if the deed says, because normally invariably earlier the deed used to say whatever I withdraw shall be considered first against the remuneration interest, balance only against capital and all that. Because what happens is when I withdraw capital, my interest should be also charged on the debit balance.
Yes.
Which I may not do if I have in current account separately and capital account separately. Right?
No, the interest, like for example, the interest is charged every year at the end of the year.
Sir, you have to analyze from open-ended. I may maintain one account, all debits credits in one account, interest calculation on the running balance. This is one method. Second method, capital account separate, current account separate. Current account debit balance, capital account credit balance. Another option? Possible?
Yes.
Yes?
Yes.
I may not be charging on the current account. If the deed says I will not charge, okay. But then your overall interest payment should be charged based on both.
No, if the interest will take into account the debits, but then it is not an expenditure for the firm. No, the firm pays tax on the expenditure which is not charged. So
if I withdraw and I pay interest to the partner, that interest is allowable.
That interest is allowable.
So it's an expenditure.
No. If you withdraw, then it is not an interest. I mean, you are considering it as an interest. No.
See, that's the reason I'm saying you have to go through your partnership deed and understand what is written there. Because many of the deeds will say the withdrawals done during the year shall be considered against.
No, the deed is silent on when to withdraw. The deed is, simply puts it as that the partners are entitled to such and such.
That clause is also not required because as per the Partnership Act, anyone is withdrawal. That's not required at all.
Then the deduction is also not required.
You have to understand that the partnership deeds are drafted in such a way that these are all captured there to have their leeway. Now that leeway has to be re-looked into because of the change in law.
So then another query. In case of non-deduction of where the assessee is not deemed as a assessee in default. So in that situation, the interest is to be charged between the date of supposed date of deduction till the date of payment. And now if the assessee who is the payee who is not does not have any other tax, then what will be the interest?
Now this is a very, very tricky question. I have paid interest to X. he is not liable to tax at all. So he has not filed the return itself. So I don't have a documentary evidence. How will I get Form 26A? Erstwhile, new rule, I don't remember the form. Erstwhile, there is a 26A. How will you get? As a chartered accountant, will you issue as a 26A? So you will not be able to issue, so you will not be able to escape. You will become assay in default. So you have to make him to file the return. You have to make him to file the return, and then that tax liability is not there. And based on that, so if he had paid, you would have paid on that date. So that is the date up to which you have to pay interest.
No, that
If you
is
don't
for-
want litigation.
no, that is for someone who doesn't file return. What about people who file return but they are not? They don't have any tax.
Whether they have a tax or they don't have a tax, or the tax is covered by some other deduction, doesn't matter. You have to prove that the other person has been obligated. Had he filed it, had the tax deducted, he would have made a claim for refund, he would have got the refund on that day.
So what will be the interest
The interest will be at the rate of 1.5% per month,
till
from the due
Date
date of
of-
deduction till the date of payment by the other party. Filing of
Payment-
return or by the other
filing
party.
of return?
Filing of return. Filing of return. There's a small leeway given if you have not deducted, and if you are deducting late. Say in the month of April 25 you should have deducted, but you are deducting on 31st March 26. So from April 25 to March 26, you can pay interest at the rate of 1% per month. But you will not be able to reflect that in your return. That interest will not be, it will go as a separate payment itself. Do not include it with any other challan. If there are no other questions, we will close it. Thank you. Thank you for the opportunity. Thank you.
Thank you, sir, once again for spending your time with us today and for an insightful explanation on Income Tax 2025, changes on TDS and TCS, sir. Thank you once again, sir. So, moving on, we have our second session by our CA B Raghav Prasad, sir. So, sir, we have our distinguished speaker. Sir, I request you to kindly occupy the dais, sir. Thank you, sir. So before we proceed into the technical session, I'd like to give a brief summary of our distinguished speaker, C.A. Raghav Prasad B. He has nearly 2 decades of professional experience, including over 15 years of independent practice in taxation and advisory. He has expertise in direct taxation, international taxation, and transfer pricing with a legal perspective on complex regulatory matters. His practice also spans GST advisory and litigation, cross-border structuring, FEMA regulations, and corporate transaction, including mergers and reorganizations. C.A. Raghav regularly represents clients before key forums such as Income Tax Appellate Tribunal, Dispute Resolution Panel, Authority for Advance Ruling, GST Appellate Authorities, and Faceless Assessments and Appellate Units. As a speaker and faculty member, he has taken sessions at CPE study circles and branches of SIRC of ICI, addressing contemporary issues in taxation, litigation strategy, and regulatory developments. On behalf of SIRC of ICI, sir, we welcome you to today's session. And I also request CA Hitan Gandhi, sir, to kindly give over the memento to our speaker. Round of. Thank you, sir. I now request CA Raghav, sir, to kindly take over the session.
Good evening, one and all. I thank SIRC for giving me this opportunity to, start presenting on the new IT Act. I've been doing a lot of presentations every now and then on the new Act, but I see a lot of interplay changes. What we need to actually, before I start on to the sessions, one word of, I wouldn't say as a caution, but one word of suggestion is that we should try to interplay between what was learned and what we are going to read now. See, in the old Act and the new Act, both almost have the same, the ideology, the intention. The Act is structured in such a manner that no big changes are actually brought in. It is only the sections have changed. Provisos have become subsections, subclasses have become subsections, multiple subclasses have become one section, forms have been consolidated. These sort of changes alone have happened. But other than that, there is nothing big that is there in the new act, except for some here and there small changes in terms of timelines, this, etc. So I have made my presentation in a manner as a comparative analysis. I'm not getting into reading of every section, because that I assume that most of us know here. So what I've generally advised people is that you find a new section in the new act. There is a corresponding old section in the old act. You have a comparative study of that, you'll be able to easily grasp the section instead of trying to completely relearn the new section. See, the basic aspect, the one-liner that I wanted to share here is, it is not a revolution, it is an evolution. There is a difference. Though it's a combination of the same, the new act is an evolution from the old act. See, there is nothing new. We are not going to completely revamp the entire thing like we heard about the direct tax code. The DTC was totally different, whereas the Income Tax Act 2025 is totally different. The substance and the basis, the form is all the same, but for here and there small changes. So I've made my PPT a small 25 slide PPT, where I will bring up the most important changes between the old and the new act, and not drag much of a time into technical aspects of litigation, etc., etc. So going forward, once again I thank SIRC for giving me this opportunity, to all the, and good evening one and all to all of the senior members and my esteemed colleagues here. So going forward, a small disclaimer as far as the new act is concerned, because as we see, as I was just coming here, I had some notification changes which was notified actually. So incorporating them as part of the everyday's learning is something that we need to actually do to get a bird's eye view on what the new act is. So that's a small disclaimer. So this is the outline of the 90 minutes that I am planning to cover, plus or minus another 20-30 minutes, 20 minutes, that's all I am trying to take. So the architecture, which is the 61 versus the 2025 glance, that is nothing but the number of sections that was earlier there, which is now consolidated now as a new set of sections. That is the initial architecture slide. Then another 15 minutes we'll spend on the assessment types. We all know about what the assessment types are. I mean, we are well versed with the 61 Act. We have seen so much assessments. Now that the same type of assessments are there, so I want to make the session more interactive as to how nuanced is the new section. Either is it friendly to the taxpayer, or either is it friendly to the department. How is the newly worded section is going to play with the assessment regime? Because assessments, like we all know now, it's become faceless. Earlier it was totally manual. In faceless, we all know that submitting entire thing online is the only recourse of action that we have. We don't have anything else to do but to submit online. Now, how is the new act going to protect us, or is the new act going to deter our client's interest, or the professionalism that we are going to show in terms of the representation? So that's the mapping of the assessment types. So that is the second part. Then provision by provision comparison, and then what has materially changed. The fourth part is something that I will harp some time on, because there are very few sections which actually underwent a huge drastic change. I wouldn't even call a huge drastic change. It is a change which was always intended to be done in the old act as well, by way of very many judgments, including the latest SC order on the JAO FAO issue. I mean, where we are still awaiting the order, but of course it's opening a new set of Pandora box altogether. So, and then the grey areas, the practical implications, and then we'll keep it as an open door session in the final session. I'm assuming you're all able to see the presentation. I'll share it across later also. It's a small presentation. So the earlier, that is, if the 61 and the 2025 Act is compared as such, the most important thing that we need to know now is just that there is no more concept of previous year assessment here. It's just called the tax year. Finally, we are now in line with all the international tax countries, where they have the year of assessment and the year of transaction is the same. In most of the countries follow the same thing. It is the same year. There is nothing called a separate assessment year. Just that there is a time difference as far as our financial year is concerned versus the calendar year, which many countries follow. Of course, the term tax year is now made specific. It is a period of transaction. That is the period of transaction for which the new act will apply. So that is one major change. So there is no more concept of PYAY. That is all. That distinction is abolished. And then the assessment chapters are numbered. Earlier it was 14. Now it is 16. As Uttam sir was earlier saying, the chapter numbers are just number change. That doesn't matter. As long as you have a good comparison table. I would also advise at this stage, as professionals, we need to have a ready-made library kind of thing where we can have a ready to look at comparison between the old act and the new act. I mean, very simple, like let's say form numbers, let's say section numbers, these sort of comparisons. The more you see, the more you easily apt to it, and you don't need to go you refer the book every time. Once you have this ready-made referencer, like maybe on a wall where you put up a small table, then that should do, and we'll be accustomed to the new act in not less than 6 months, I believe. So chapter number is rechanged, and then the charging section is all the same. Faceless assessment. The new act gives a lot of importance on the faceless regime. See, that was the whole intent when the faceless assessment was brought in way back in 2021 post the COVID. Thanks to COVID that it brought this sort of new set of regime, and it's taking its own colors, its own shapes. It's getting redefined. It's getting better and better day by day. You have a lot of notices which are in detail. The point is now, how far as professionals or as assessees, how far are we suitable to handle these kind of notices which are long. Simple 141 notice earlier used to be a 1-page notice. Nowadays you get 141 notices for 4 or 5 pages. Now how would you educate your client for him to give that information at the first place? Forget the matter that you represent the facts later, but the question is, how do you make the client understand that he is obligated to give these details to make the assessment in a error proof manner. So faceless assessment, this act has given a lot of importance to faceless assessment. Reassessment, the time limits have been modified now, slightly modified I would say, because the earlier 3 years is all the same. The earlier 10 years for foreign assets is now 6 years. That is the only change as far as the reassessment is concerned. Small change in timelines. The concepts, the litigatory aspects is all the same. The concepts of reassessment, information suggesting escapement of income, all those terminologies are all the same. The earlier judgments rendered during the course of the old act remains the same. There is nothing that has changed. I don't know how many of us have had a go through of how the 22 Act became 61 Act. Anybody here? There are beautiful books on that. I mean, now that I have senior professionals here, I'm sure they would have seen somewhere about the 22 Act. But there are beautiful books on that topic as to how one particular act is replaced by another act. Why a section has undergone a change from this wording to this wording. This is all based off of a number of judgments, number of cases which come up, the Supreme Court setting up certain kind of laws, the Parliament bringing up new set of amendments, retrospective amendments. These are the key changes which every particular section goes through as a change in every finance bill, and a consolidation of finance bill keeps amending the acts all the time. So a 22 Act to a 61 Act transition, if you see, we had the same set of objects. The section numbers were very low there. Then it got enlarged to 61 Act and said they covered a lot of aspects in 61 Act. Now to 61 to 25, I would still say the same thing happened, because if I can able to draw up a similar table, we will still have the same set of provisions in 22 Act. The same set of provisions was there in 61 Act. The same thing continues in the 2025 Act. Nothing was abolished. Everything is now made crystal clear. It's made more easily understandable. It's not made, it's now not, it's a layman statute. It's not like the earlier statute which only professionals can interpret and understand. Gone are those days where what are the meaning of explanation, sub proviso, sub clauses, explanation to subsections. So these are terms which are very much reduced in the new Act. So that way, the comparison between the 61 Act and 25 Act is not much actually. Even if you go section by section, the wordings are still the same, but for the section number and changes, I'm still wondering why that change in numbers happened, because people have been used to so many years of using the old form numbers, old section numbers. But anyway, change is the essence of life. So that way it goes. So I'm not trying to cover on the search assessment, because search assessment by itself is a huge topic to be discussed. Again, no big change between the old and the new act, but I'm not, for the limited purpose of this 90-minute session, I'm not covering on search assessments. The digital powers, that is something, a new thing which the new act has covered. There's something called VDS. We have all heard of what VDA is. What is VDA? Virtual digital asset, which covers the crypto coin base. I mean cryptocurrencies. Now we have something called the virtual digital space. So they are defining what VDS is, and they are wanting to include VDS in part of the sections where they wanted to make the assessment. Now what is VDS if you ask? It starts from your electronic trail you leave everywhere. You know, how many of us have turned on locations on a mobile? Now this is called a VDS. So they know where you are, at what time you are there, what is the evidence that you are left, which place you are there. You can't come and say later that I am not there, I was not there at that point in time. Not possible anymore. So this is just a simple example of a VDS. They are trying to cover and include everything that's there as part of the electronic space, which I would say from WhatsApp chats to backups to Gmail, you name anything on the electronic internet media that you are using today. The moment you are exposed to internet in some form, mobile, internet, laptop, desktop, any form, your tabs, you are connected to internet, you are open to VDS. So now whatever trail that you leave there is all now notified information for the income tax to access it and use it against you also if required. Now those are the most important changes, I would say. And as you all know, AI is now taking huge forms. Day in day out, it's taking a new form. Let's imagine how AI in this VDS is going to be used by the department to capture information about the taxpayers, or to capture information about the chartered accountants, or to even see, we all know about audit trail. What was the objective of audit trail? It was to capture the changes that were made. You can never delete the audit trail. That is the whole purpose of audit trail. The same manner, even the VDS is now trying to capture your old electronic record. Might be you would have disagreed to a particular electronic record, but still that electronic record is still available, and they can still use the same information against you, or even to track a professional against that. So that's the VDS as part of this change in the 2025 Act is something that I see big, because I see a lot of changes. I'm expecting a lot of changes, because with AI interplay and the National Faceless Assessment Center, or for that matter the National Faceless Appeal Center, both of them are now being faceless completely. I'm definitely sure and the entire information being submitted online, let's be voluminous information, let it be small information. Now those information are going to be used and analyzed by way of AI tools, right? I'm sure most of us know that our own institute has a separate AI division, and they are now giving a lot of insights as to how the government will also use AI to process information that they are collecting, whatever source it might be. See, imagine in a virtual digital space, they use AI to analyze everything and populate information and say, this is what you have done, this is what you have done, this is something that you have done there, we're collecting all this, we are now filing a case against you, or we are initiating a proceeding against you. Now, how are we as professionals going to defend this? Don't you think that we should be first aware that we should be aware of how to use these technologies, the cloud, the email, name anything, the WhatsApp, the trails that you leave in messages, all these are information that we need to be aware as to what we are sharing, what trail we are leaving at what place. So that is the small digital powers that this 2025 Act is going to bring up, which was not there in the 22 or the 61 Act. To be straightforwardly put that way, it was not there. Totally it was not there. That is something now included as part of the 2025 Act. So this is the section mapping. A simple, most essential sections I would have captured here. So as you could see, self-assessment, we all know the section numbers is same, no change in concept. I will not spend time. Wherever there is no change, I will not spend time. I will give this comparative table. I would also advise, whoever is handling assessments here, I would advise that this particular mapping table is there. Let's even take whatever chapter as far as the Income Tax Act is concerned. When a transition happens, this sort of a mapping table is very, very easy. Please do not advise our juniors to use references or reckoners. Those are the first steps of being damaged. Never use references. Please make them read the act. Give them a simple referencer. What the old act number is, what the new act number is. Please make them go read the section and let them make a comparison. That's the most easiest apt way of training them. So wherever there is no change, I am not making, I'm not dwelling so much time. So 140A self-assessment is now 266. 143.1 is now split into two sections. Remember, we used to have 143.1A. Before the intimation comes, the CPC used to send something and saying, I found these errors. What is your reply? Right? This 143.1A and finally 143.1 was the old act. Now it is now 268, 269. Just like our reassessment, where the initial inquiry stage is 148A and then they proceed to issue 148. Likewise, even in an arithmetical computation, you all know that 143.1 is just a summary arithmetical computation of your return of income. I don't want to get into issues as to what all can be assessed in the 143.1. Does CPC have powers to do such a kind of assessment? Whether 143.1 empowers CPC to make additions from third-party reports. Like when I say third-party reports, I'm not saying completely third-party reports. Like let's say reports like tax audit report, your TP report, your certifications in Form 15 CB. Can the department use information from these audit reports, these forms, and come and say that you have not shown this in the return of income? You have not done this in the return of income. There is a difference between the tax audit report, the TP report and the ITR. Does the CPC have power to do such a kind of comparison? Anybody has faced such kind of practical issue? I mean, the CPC picking up information from the tax audit report. They pick up information from the transfer pricing report. Let's be international TP report or the domestic report. They pick up that information and say, this particular information is not there in the ITR. Now I find this as a difference and I want to make the addition. Now where are we there? Does the CPC have the power to do that at the first place? The straight answer, if you ask me, it is yes. But the question is, to what extent they can pick up information? Can they go ahead and say, the computation made by the tax auditor in the tax audit report is wrong, and the CPC makes a different computation and says that they want to make this as an addition? Now let's take an example. As a tax auditor, you would have reported 40B5 remuneration, correct? In the tax audit report, you report remuneration. Or let's take, you report some disallowances on 43B, statutory payments. Now, can the CPC compare the TAR data and the ITR data? That comparison is straight comparison, anybody can do. They can make the disallowance. Now, do they have the power to go recompute the disallowance made by the TAR or made by the tax auditor? The answer is no. But the CPC is empowered to make such computation. The systems are so computed or rather it is framed in such a manner to make these sort of computations and then come back to you with 143.1A and say, I found these discrepancies. What is your answer? Now, a classic example in the recent times is the trust exemptions that we are facing, 12AB exemptions. Now, 12AB you would have applied for renewal. Renewal could not have come for whatsoever reason. You would have not filed Form 10B, an audit report for a trust. Now, can the CPC come and deny the Section 11 exemption? The answer is no, because CPC is empowered to do only an arithmetical computation. They can't get into aspects of law and say, you have not filed Form 10B, which is an audit report for trust claiming exemption under 11. It is a procedural defect. Now, can CPC come and say, I will deny your 11 exemption and add up everything as your income? The answer is no. But the CPC systems are framed in such a manner that this is how the processing will happen. Now, the same thing is now getting enacted in the new act also. So, kindly be aware. I would even advise to the extreme step of saying, you are being an auditor. Just do your duty of being an auditor. Don't get into filing of returns. That's not your job. Because the extent of litigation that we are looking at today is something that the same auditor does the tax audit report, the same auditor signs the financial statements, the same auditor comes and files the ITR, everything from his own one laptop, finished, IP address tracked. All three of them the same person. Now the same three data is being used by CPC and there is a default because of whatsoever reason, for the reasons that I said, that I gave as examples. Now, is not the CA exposed in this situation? The answer is clearly yes. If the department or the client initiates a complaint to the DC committee of our institute, the CA is in problem. So, when you do all three datas, meaning the ITR, the tax audit report, the filing of audit reports, or for certification of forms, ensure the reconciliation is done between the three. Without doing the reconciliation, please do not file all the three by yourself. See, that is a small piece of advice I would try to give here, because the kind of automation which the department wants to use now, you are all envied about the fact that we are getting the refund in 24 hours. How do you think it is possible? It's all system. Nobody sits manually. System is comparing and it is checking with the 26 As, AAS, TAS and cross-checking information from everywhere, cross-checking that with your ITR. If everything is okay, it gives you the refund, that's all. It's only summary processing of the returns. Now, if you don't do the reconciliation, what happens? Now, that paves way for you as a professional will not even, you will not be able to foresee this. But your unreconciled information in the ITR or the TAR paves way for a scrutiny or a reassessment or a revision for the taxpayer for no error of the taxpayer. Do we all agree on this? There would be XYZ information on the AS. The client would have given ABC information to you. You will see, but there might be information which should have gone past your reconciliation. Now, without such a kind of reconciliation, if you file the return, automatically system picks it up for scrutiny. System sends it the notices. Nobody sits manually. All our assessment notices today are electronically done. Nothing done manually. So, that is the extent at which they are trying to rationalize the new act to include the electronic processing of the information. So, that's where I want to harp more time. On each kind of assessment, I will try to give some practical issues so that we are able to correlate as to what we are doing. So, that is the scrutiny notice. So, 143.1, small issues, but yet can lead to a lot of issues following up the 143.1A or the 143.1, which is a new section called 268 or 269. Now, what is empowered under 268? That is a separate chapter altogether, like I was discussing. Can the CPC come and say that I will interpret the law and say I will disallow your 11 exemption for non-filing of your 10B audit report? That is a totally different perspective here. But what I am advising here is that please have the reconciliation done between the ITR, the tax audit report or the forms that you file. Because without reconciling this, if you file anything, then automatically notices come up, because nobody sits manually to give you or issue notices. So, then coming to the scrutiny notice, earlier also it was the same section, now also same section. It is faceless now, no more manual officer sits. Again, there is a set of guidelines which the CBDT has issued. The guidelines are very simple. It was there in the previous act also. How many of us actually look and process our ITRs to see if our ITR information will get picked up by these guidelines? There is a guideline, there is a 5-page direction by the CBDT, which they have told that if these informations are straight away possible from the ITR, then automatically pick it up for scrutiny. These are scrutiny triggers, like for instance, huge increase in creditors, sudden decrease in turnover, refund claim inconsistent with the turnover, inconsistent with the taxable income. These are all scrutiny triggers. How many of us actually look into these and then process our returns? The answer is no. Practically none of us look at this, correct? Now, I am not saying you should bypass and alter the computation and try to fit in within this regulation so that no scrutiny comes. All I am saying is be aware of what these triggers are. Educate the client about that. Show him the draft. Tell him that, boss, this is the difference. You will definitely get the scrutiny notice, because it is automated today. Moment you file the return, it will automatically come. That is the extent at which the processing of returns are now being taken care by the Faceless Assessment Center, or for that matter, in the recent amendment, they brought new 147A, which said faceless or jurisdiction, both are called assessing officers. That's all. Finished. No question of manual intervention or automated intervention. Both are considered to be the same. Both have the same powers. Both are supposed to have the same quasi-judicial powers also. So, with that kind of automation, I would advise you to at least educate the client as to what could be the possible reasons for which a scrutiny can come. So that is the section at which 143.2 was there in the previous act. Now it is 268 notice, faceless default notice under 268 or 273. Now the reason why I am saying this here is because automated, again, I am time and again repeating, if the ITRs do not match, it compares the previous year ITR and the current year ITR. If there is substantial increase, you would have just missed up one column. Instead of putting in the previous column, you would have put it in the next column in the subsequent year's ITR. Gone, finished. System picks up for scrutiny. It is simply a disclosure error, but system does not look it that way. It straight away compares sundry creditors this year, sundry creditors last year. So this notice is automated. The moment this notice is automated, then automatically every other issue opens up. They are free to see anything in your return that you have filed, right from your turnover to your balance sheet items, you name anything they can look into. Now you are opening the Pandora box for a small error. Now this is something that we need to be careful on while we look at processing of the ITRs and the TARs. So because 143.2 is now been automated. The new 143.2 will come under 268.1. I am not very keen on giving you the new section numbers. For the matter of discussion on the session now, I will retain to the old section so that you are aware of what the issues that are involved, and then you can all automatically map with the new section. So then we have the best judgment assessment, which is the I would say it's a Super 6 over today, because with the NFAC coming everywhere, left, right, center, you don't have information, notices being replied, they immediately give you best judgment notice. The best judgment notice that we have all read about is you don't respond, then they gather all the materials, then from the materials they gather, they give you a show cause notice, they give you a justification as to why they want to do a best judgment assessment. All was the regime in the previous act, not in the new act, because it is a prescribed standard format for giving a show cause for best judgment assessment. Best judgment assessment, there are a lot of preconditions for them to initiate a 144 assessment, which is now the 271 assessment. But now the notices are being online, the client doesn't even know that the notices come online. We as professionals, we are not bound to check their online portals every now and then for the scrutiny notice. Now what happens in that case? Every case will fall under best judgment assessment. Do we have a risk or not? The answer is a clear yes. Now how do we come over this? Because the simple aspect is because the moment you leave the assessment side and it comes to it transforms into an assessment order, then the litigation issue starts. There is no point, because again you have to start from everything, start from the scratch, as if you are going to submit the details for the very first time, submit it before the appellate authority. Nowadays the new act is now empowering the first appellate authority itself to remand back the matter back to the assessing officer. Earlier Income Tax Act never gave the power to CIT appeals to remand it back, right? Now the new act gives. The appellate authority is simply empowered to remand back the matter to the AO and look the matter for a fresh consideration. Why? Because you have not submitted in the past. Which is whose mistake? It can be client's mistake, it can be professional's mistake also, because we would have not enlightened the client to make them understand that, boss, hereafter notices will only be online. Please be aware of your email. Please be aware of your mobile phone SMSs. Without you telling me, I will not be able to respond to the notices as professionals. Now these are the reasons why we get into a best judgment assessment, because the notices go unresponded. The matter of being unresponsive is now taken by CPC, or rather the NFAC, National Faceless Assessment Center, as a negative against the client. They don't consider the actual plight. For all we know, the client might not have been tech savvy at all. He might not even have a computer. How will he be able to access the computers? Now, but for we professionals educating them, they will never be able to know. But the NFAC does not give any such sort of recording in the orders. They simply put up a table. They simply say date of notice, due date for responding to the notice, response received yes or no, response remarks. That's all is a column. One simple tabular column, and say they have not responded to anything. Therefore, following the principles or directions of the Supreme Court, I am constrained to invoke provisions of best judgment assessment, and they do the assessment. So this is unnecessary redoing the same work, and again they have to come back to an appellate authority, plead the same set of facts, everything, and go again. So best judgment assessment, I would say in today's era, if you are not able to respond to the e-notices that are being served on the portal, this is automatic today. And they have preset formats for that matter. So that is on best judgment assessment. Then we have 144A directions, which is the Joint Commissioner's directions on specific cases whereby if there are complex legal issues or interpretationals based on decision which needs to be considered by the AO, the assessee can make an application to the Joint Commissioner for a reference, which the Joint Commissioner, after going through the case, can direct the AO to do the assessment in so and so manner. That is 144A under the old Act. Now it is 272. No change as far as the intentional section is concerned. Faceless assessment, something I want to make some 5 minutes time here. We all know faceless assessment is now taking new shapes day in and day out. The reason being is that everything they want to make it contact free, person contact free. You submit online, I will see online, I will pass online. You want to make submissions, make it online. Don't give me excuses of saying a portal is not accepting, I submitted manual papers, they did not consider. You submitted record is there online. Nobody can deny it. Like I was just telling in the start, electronic trail. What sort of trail you are leaving? Imagine you submit everything in the assessment portal and there is an order which comes and says that you have not submitted anything. Now, do we have a strong case here? Yes. The answer is yes. Whereas in the past assessment years, in the past about 10 years before, we had nothing like this. We only used to have tapal. We used to manually submit papers, get the chapa there, and then come back and have this paper alone and said, we gave all the information, the assessing officer has not considered. Now imagine in the faceless assessment, everything is now online. You don't submit, recorded online. You submit, recorded online. You submit your objections, recorded online. Now there is no question of ifs and buts, right? So the piece of advice here is submit everything, substantiate everything, whether they call it or not. Be specific to the question they raise, because in the faceless assessment powers, if you read 144B in the old Act, the same thing is also there in the new Act, nothing big, but it is made statutory. In the old Act, it was not statutory for all kinds of assessment. Certain assessments at certain stages had manual intervention, certain stages it had faceless intervention. For penalty, it was certain stages manual intervention, certain stages faceless intervention. But today, after introduction of 273, starting 1/4/2026, every set of proceeding initiated under the new Act after 1/4/2026 is all to be faceless. Nothing is manual, except for notifications which are yet to come, which are specifically very rare in cases of search, block assessments, or Director General investigations or black money investigations. There are very limited provisions which still have a manual interface, but there also the aspect of DIN is there. But the question of validity of DIN is now being retrospectively removed by the department. So DIN is also not there now. But faceless regime, as far as making assessments, that is 100% faceless now. Nothing is manually to be intervened. So if you find a manual notice issued by a jurisdictional officer that is to be challenged, please do not respond to it, participate in it, and then, because they collect information from you and then make a faceless assessment. Beware of this aspect also, because there are certain provisions where they cannot collect information from you, they cannot make a fishing roving inquiry with you, use the same information collected from you and then use it against you. Not possible, not permissible under the new Act as well as the old Act. It has been a settled principle. They cannot do fishing roving inquiry. They should have concrete information about you and then share it with you, ask what is your justification on that information, and then proceed to make an assessment. So that is a faceless assessment. The earlier provisions are retained. Their powers have been extravagantly given to the faceless assessing officers. So beware of the faceless portal. Be used to the e-filing portal. That is where all your notices get uploaded. Nowhere else it gets uploaded. There are multiple tabs under the e-filing portal. Had it been a longer session, I would have given a live session itself here. I had the privilege of doing that in a previous conference, whereby I had from start to scratch, I had made the entire team to go through the live display of how the proceeding happened, where all they picked up information. The simple pickup of information was from a 133.6 notice. 133.6 is just calling for information, right? 2 years before, they would have collected some information from you. Did you even imagine at that point in time this same information would have been used to make a reassessment? The answer is very much yes. The same information was used to make a reassessment because 2 years later the assessee did not put up that information inside the return, or they did not reconcile that information inside the return. So it is the same 133(6) information which was used to reopen the assessment and make a complete completely against judgment in that particular case. So I had the privilege of showing that, but anyway I will brief you on that, because there are so many portals, tabs in which you can see all these notices in the e-filing portal. So beware of it. At least if you are not able to, at least please educate the client so that they are aware as to where all the notices can come. So that is on the faceless assessment. And then the CIT reference, I don't want to touch on that. The DRP route is still the same. Earlier it was 144C, now it is only 275. As we all know, DRP is only for non-residents and transfer pricing cases. That's where DRP comes into picture. A draft order is given by the AO. If you have objections against the draft order, go to the DRP, object it. Then the DRP will give direction to the assessing officer. AO will pass an assessment accordingly. No big process change as far as the DRP proceedings are concerned. Income escaping assessment, like I told before, only the time limits for issuance of 148 notice is now slightly altered. Otherwise, I don't see any big change as far as the new act is concerned. So the old concepts of reopening assessments still alive. All the old judgments are still alive. They can still be used under the 2025 Act. Nothing differs. So how many of us have actually faced the reopening assessments here? Any practical exposures, doubts? We can make interactive sessions so that as and when we can get the doubts clarified, because as I move forward, it will be more specific to kind of assessments and issues faced. I don't want to be more theoretical as far as the subject is concerned. So anybody, any issues on reassessment, reopening notices? The concepts are all the same. Anybody? Any issues on that? No. Okay. So let me proceed on that. We'll come back on reopening again, because reopening is the key today. All the information, including the VDS information, virtual digital space information, that's being collected and being used to do only a reopening assessment. Please be aware, reopening assessment earlier was a specialized tool, not available at all the time. Now it is a regular tool available for every proceeding. That's how reassessment is now reframed. They use all the information to come and put it under the reassessment set of sections, because what the wordings has now been changed is information suggesting escapement of income. Simple. If you break all the three, what is information? It can come from everywhere, starting from VDS to physical notices to information from third parties, information from survey, information from search wings, information from Black Money Act, information from your your cross country sharing information, your FATCA regulations, which between the countries they share information. All these are information. Now they can use all this information to come and reopen an assessment which has been already closed under your regular provisions. The answer is yes. Under the new act, that is being empowered. So beware of the income escaping assessment. The timelines alone have changed. The concepts are all still the same. Please be aware, because the only advantage under the new act is that we are now given a 1 year time frame. Earlier, the inquiry proceedings under 148A was just 3 months. Now we have 1 full year. They can do fishing rowing inquiry. Fair enough, no problem. But I don't want the notice to be issued, because once the notice is issued, an assessment has to be done. That is how the provisions are. Now they issue a notice saying, I have some information suggesting escapement of income. At that stage itself, please close it. Give up all your details. They have as if now amended the section to say, the inquiry, the proceeding itself is such as if an assessment being done, because it's that long. It's being a 1 year time period being given. It's called a moratorium period under the new act, but it's not specifically named that way, because for conducting an inquiry, they are giving you 12 months time. Now, what if you are able to completely substantiate your case and they drop the inquiry proceeding? There ends the matter. You don't need to get into the rigors of 148 provisions and then go on penalty and so on and so forth. So we should take advantage of this particular new insertion of this change in timeline. So please be careful about the moment you receive a 148 notice. Ensure you get to solve all the information they have. Call for the information. I was just dealing up a case about 2 hours before. The information they had in the 148 notice has nothing relevant to that particular assessee. That's the beauty. The error crept up for the reason that the demat or the share broker didn't update his KYC. The demat was a joint account. First holder is the husband's account. Husband is the sole earning member. Wife is the joint holder. The demat person had updated the PAN number of the wife. Finished. The wife gets a reopening 148-day notice for no income that she has earned. Where will it be substantiated? So look at where the information flow is going. You didn't do any mistake. The client didn't do any mistake. Some third party holder did not update the PAN correctly. So that went on to information saying that there is no ITR filed for this assessee. How was the investment made? Therefore, this is information suggesting escapement of income. Therefore, I am proceeding to issue 148 notice. Now, at this stage, you can't do anything because the stage at which I have received this client is that they have already received the 148 notice. But had it been responded during the 148A, isn't it not a small issue? Because just a matter of explanation that it is a joint account, husband's contribution to the wife's joint account, both of them together are holding the demat account, husband's return of income substantiated. They will issue, because reason being is that there is a procedure which you need to follow while filing the return of income. I don't know how many of us do. Do you all know that we can respond to the information that is there in the ASTAs? You can respond? Yes? No? How many of us have responded before filing the return of income? Before filing the return of income. It belongs to me, does not belong to me, transaction is double entered, SRO is wrong, demat holder information is wrong, bank information is wrong, all this information can be submitted. Now, assuming this information is submitted prior to the filing of the return of income, then will not the 148A itself fail? The roving inquiry itself is failing because the information they are having is wrong. This is the importance of when to attend what. You lose this particular opportunity, then you're not left with any other opportunity but to go and substantiate everything from start. But how? They will issue the assessment notice, they will give all procedural notice, they will give an assessment order. They don't even know what for which they have opened the reassessment order, but they will still pass an assessment order. How many of us today know the principles are so stringent, rather the courts are very stringent. Let's say issue number A for which an assessment is reopened, right? Now you give all justifications whether during the inquiry proceedings or during the reassessment proceedings. You give all the information and the AO is satisfied, right? Now, can still the AO pass a reassessment order? The answer is no. You cannot pass a reassessment order accepting the returned income, because an assessment is deemed to be complete the moment the statutory time limit for making a regular assessment expires. Now, why did you use the reopening tool mechanism? Because it's a special mechanism, special section. Why did you use? Because you had suggestion that something escaped income. Now that was justified, it is explained, it is already taxed. Then are you allowed to make an assessment order? Answer is no. But how many of us are practically challenging this? Assuming the reassessment order is passed, imagine, I am going to tell you the next set of problems that the client is open up to. The assessment year life is reopened. Another 2 years will get reopened from the reassessment order. Technically, the time limit would have got expired had it been the original assessment. Now, for reaffirming the original assessment, meaning returned income accepted, he is passing a fresh order. Now, from this order, another 2 years will creep. From all other sections, revision, amendment, 155, suo motu rectifications, to make a reassessment also. Again, everywhere time limits revive. Now, we are giving ourselves extra timeline by not challenging this. These are small issues. That is why I am repeatedly telling, make the attempt to completely answer to the inquiry proceeding itself. Ensure you don't receive the 148 notice. Because if you receive the 148 notice, then the issue is different. So be careful about that. So that is what on reopening notice. The pre-inquiry show cause notice is the earlier 148A, it is now 281. And then the time limits, like I told before, earlier it was just 3 and 6, now it is 4, 4 and 10, now it is 4 and 6 for high value transactions. Approval hierarchy is still the same. These are all practical implications. How many of us actually check whether the approving authority pro forma is given? 151 approval is a primary criteria for reopening notice. That is still alive. The sections are still alive. And now imagine this section is now made online completely. This pre-approval proceeding is to be given to you as a matter of prudence. How was the approval given, etc. is something to be given completely to you without giving. If they proceed to make the reassessment, then you are gone. The reassessment fails. This reassessment 151 approval is part of the scheme now. It will be available in the portal. Now let's assume you don't have a valid approval, but you still have a 148 notice. Isn't it time for you to go and challenge it instead of participating in the proceedings? You make cognizance of the proceedings by mere participation. You will be in the expectation of, I don't want litigation free. But imagine the plight, the legal failure itself is not answered here. So that is the approval hierarchy. Completion, again the same thing, 153 timelines apply. 153 timeline is what I was just harping before. See, imagine you are giving fresh timelines by accepting a reassessment order for confirming the returned income. Returned income is already got confirmed. So why do you want to give way for a fresh assessment? Block assessment I am not touching. So this is provision by provision comparison. This is the 143.3, like I told you before. It is now default. One other practical question. In an assessment, let's assume a return is filed after the 148 notice. You have not filed the original return. You have filed a return afresh in response to a 148 notice. Now, is issuance of 143.2 notice compulsory, mandated? Yes or no? Against the 148 return. You have not filed the original return. You have not filed the original return under 139. Let's for ease of understanding, we'll keep the old provisions so that we can easily understand. Now there is a small tricky question. The 148 notice says 90 days time is given. You filed the return on the 91st day. Now what? 90 days 148 notice is there. 91st day you file the return. For the very first return for that assessment year is being filed on the 91st day. But before making the assessment order is yet to be passed. Right? Now, the technical change that has come in the new act is that the return filed beyond the time prescribed under the 148 notice is treated to be invalid, non-A in law, which was a proceeding to be done separately by the assessing officer during the course of the proceeding. He should first declare the return as invalid and then proceed to make a best judgment assessment and then give you a show cause notice and then proceed to make the assessment. But you always have the right to make a fresh claim by way of filing a computation of income. I am not saying a return of income, please be aware, a computation of income on the income that he is already having, on which he has made a reopening attempt, or even during a regular scrutiny also. You can still make a computation of income. Tell him that, boss, this is my actual earnings, this is my actual total income, my tax deduction, etc., etc., etc. Now, can this computation be a material and record for the assessing officer to make an assessment? The answer is yes. The new act is very specific on that. Like the old act also, the new act is also having the same provision. So, just because you didn't have an opportunity to file a return, don't just leave the opportunity of making the claim. Please make the claim during the course of the assessment. Also a very interesting question. Now we have this updated return, right? I mean, in the new act, it's like, I don't know till when they will extend. 8 years is the latest limit. 6, 10, something is the latest limit. No, 4 got extended by the FA 26 Act. I think it is 6 years now. 6 years of an updated return. Imagine 6 years if you have the time to update it. Then imagine the time limit for reopening it. 4 years in the reopening section. If it is going to be more than 50 lakhs, 6 years, then 6 plus 6, 12 years to make an assessment. In this 12 years, imagine how much information I can gather to make one assessment. Now the question that I was answering yesterday or day before yesterday, I think, can an updated return be filed after issuance of 148 notice? There is no express restriction under 139(8)(a), is there? I am talking the new act. Okay, I will slightly answer alter my question. can you file an updated return prior to issuance of 148 but after 148A? There is a 12-month time frame, right? In the old act we had 3 months, now it is 12 months. Let's say it's called inquiry period. This is an inquiry period. In this inquiry period, I had initiated 148A. The new section is 271. But they have not issued the 148 notice. Now in this intermittent period, can I file an updated return? There is no express restriction. Imagine that is the trick here. You file an updated return, the CPC rejects it. This is the case that I am facing now. Now we are before the High Court. The CPC simply rejects it, saying proceedings for this particular assessment year has commenced. Therefore, your updated return is invalid. The tax paid is gone. It is gone into the elephant's mouth. That is there saying stiff. My return is treated as invalid by CPC. Now, whatever information I myself wanted to give is there, but treated invalid. Now, is this not you yourself giving your information to the department to make an assessment? There is no power to CPC to reject this. There is no express provision. The 8A, 139A, the earlier current 270 provision also still says you can file an updated return prior to the issuance of assessment notice. This is just an inquiry proceedings. Just like how your 131 summon, your 133.6 calling for information, all these are procedural sections to collect information. That's all. They are not giving the power to make an assessment. The section's intention is very clear. After I commence the assessment proceeding, don't come and say I have filed the return. That is not allowed. That intention is very clear. So, the case here before the High Court is that whether the CPC was right in rejecting my updated return prior to issuance of 148 notice. The answer is technically yes, but we need to go to the High Court, fight till the High Court to substantiate this aspect.
I go down this path instead of going to the High Court?
The answer is actually very skeptical, very straightforward. The moment CPC says your return is invalid, right, then you are forced to file only in response to 148. Correct? Now, the penalty provisions simply use the word returned income, assessed income.
Correct.
Your returned income is 0.
But penalty also says when you offered it during the course of assessment, the penalty says it will not be levied.
I am simply saying 270A, which uses the word returned income, assessed income. Your return is 0. You are for the very first time filing only in response to 148 after I found the information. So, penalty is straight applicable. Whereas, in a case that I was just discussing, when you file during the inquiry proceeding, the return is treated as valid. He has all the rights to process it under 143(1), go through the mandatory time limit of 143(2), have the expiry of 143(3) time limit, and then only revive to 148. He cannot directly invoke 148 because it is a valid return under 138A. Now, had this return not been there, had this return been only in response to 148, it is for the limited purpose of making the assessment. The income is the income that I have found out. You have not voluntarily disclosed. The rigors of penalty of 100%, 200% might apply. Like in the case that you told, I have voluntarily disclosed during the assessment. Therefore, the rigor of penalty might not be 200%. It might be a reduced percentage. Even in the new act, that sort of relaxation is given. But the penalty is open now. They are free to initiate penalty because I only found the income. You thereafter coming and paying taxes along with the interest does not give freedom from, does not give protection from penal provisions. That is still open. That is the advantage of filing during the inquiry period and post the inquiry period. Going forward, so then the mode of service, it's all electronic, nothing is manual. Please be aware once again, nothing is manual. Please educate your client on to see and check emails. Please do not give your own email in the assessees portal, that you are paving way for all DC cases. I know most of us are, for ease of doing, managing the clients, we all give our own email IDs in the assessees portal. Please stop doing it, because the assessee can simply come tomorrow and say, You received every notices, you received everything, you only are the reason for me getting all these demands, I will file a complaint to the institute, finished. That is something different. I am not commenting on ease of doing business, but do the ease of business with care and caution. Please be aware, please remove all your own email IDs, ensure the client is educated, please give the client's email ID, because all mode of service is, nothing is manual and nothing is physical anymore, everything is electronic. Then the show cause notice, then draft order. So let's move on. This is the reopening. We were discussing as part of the discussion itself. So pre-enquiry, then the notices on 148. How many of us know the difference between issuance and service? There is a huge difference between mere issuance and service. Which section requires service? Which section requires issuance? There are practical cases which, of course, poor department, they can also do. It's only going to be system. The notice will be dated 31/3. That's where the last date for the timeline expires. If you see down forth the digital signature, if you click on the digital signature, it will show 31/3, 23:53 time of signing. Okay. But then if you log into the portal and see, it will be given, you will receive an email on 1/4. Such a notice is illegal. If you are going by the wordings of 143.2, which is the notice for making an assessment, 143.2 requires service, not issuance. Now the service is made on 1/4, you would have issued it on 31/3, but service is on 1/4, which is beyond the timeline. We will not see to these criticalities, but yet go and respond and make ourselves participated in the assessment. I mean, for all we know, if we can justify and get a good order, well and good. You can also bill and be happy. But what if you are not able to get a good order? Is it not a next round of litigation? Small intricacies. So be aware of what is service, what is issuance. Certain sections require service, certain sections require issuance. Beware of it. And again, once again I am telling you, all service is by email, nothing is in manual form, everything is in electronic form. Now whether service by email alone is sufficient service? Another interesting question. Now the portal is not uploaded for whatsoever reason. It comes to your email. In the portal it gets updated 2 days later. Now what is the course of action? These are all practical issues. As we get on to, I had a beautiful interesting case about 3 years before in a block assessment. All the orders were uploaded, but when I downloaded the order, it gave me a Word document. The entire order was in a Word document. Not signed, not the name of the officer is there, no signature, nothing. I got a Word file, .doc file as an assessment order. Now is this a valid assessment order just because it is there in the portal? The answer is no, because the earlier scheme did not give payway for all this. Now the current scheme is making amendments to say that moment it is uploaded in the portal in whatever form, in whatever format, it is still considered to be valid notice. Now imagine if one doesn't know what a computer is. I am sure nobody will be there like that, but imagine somebody is there. Now where is the principles of natural justice here? He doesn't know computer means he doesn't know computer. What do you do? So imagine the extent of, we need to teach the client to that extent so that they are aware of where all they can get problems. So be careful on that. So completion of the reassessment, of course, earlier it was 9-12 months on 153. Now it is simply 12 months in terms of all kinds of proceedings, whether it is a redo assessment, whether it is a fresh assessment, whether it is a reassessment, whether it is a giving effect assessment, whether it is a giving effect to an appellate order. All these are 12 months from the end of the, either the end of the month. In case of court orders, it is end of the month, or in case of it is other orders like appellate orders from first appellate authority or tribunal, it is from the end of the financial year. Depending on the kind of proceeding, this time limit changes, but it is only 12 months standard. Not like the earlier 153 which had 3 months, 6 months, 9 months. That thing is not there. It is rationalized now. So the show cause notice part, I mean here also be very specific. Our 148A, the amended 148A as well as the note 281 is all giving specific timelines itself. As part of the section, they are simply saying 21 days time is to be given. 7 days time is to be given compulsorily. If this time is not there, the show cause notice is invalid. Please respond to that saying you have not given the sufficient time as mandated by the section. Please do not reply urgently and give wrong information and get onto the trap. Because even they are human beings looking at the system and processing the notices. They are also having the same set of information. Like an IT company, they are having information running into pages of very many assessees and taxpayers. Now they will not have time. So where they have to give 7 days time, they will give you 3 days time and they will make you respond. Now you don't urgently give within 3 days. You simply demand your 7 days time as granted by the section. So beware of every show cause notice and object to the show cause notice if there is something against the law which is mandated. So this is the step-by-step process. AO has information which is 147. Information like we discussed, now the scope is widened to include everything. Whether information in ASTAs can be information under 147, the new act is saying yes. Because of the earlier introduction of a section called 135A, which is faceless collection of information. Imagine, look at the words they use. Faceless collection of information. I use the system, I collect information from everywhere. That is faceless information. I have information, that's all. That is sufficient. I will issue the notice, tell you what the information is, now you tell me. That is how the structure is framed now. So that is AO has information. And then show cause notice, now it is 281, that is the inquiry proceedings, which is now spanning over a period of 1 year. And then the order approval, earlier it was 151, now it is 281. Everything is embedded as part of 281 itself. And then the notice for return, which is the 280 section, earlier it is 148. The same timelines apply, nothing big, nothing different at all. So that is just a small commentary about Ashish Agarwal. I am sure we all know about Ashish Agarwal. I don't want to spend more time on that. So this is the faceless assessment. Now the same faceless assessment which includes faceless reassessment, the procedure to conduct an assessment faceless is now completely embedded as part of section 273. Earlier we had two sections. One is 144B for making a regular assessment, 151A for making a reassessment, faceless reassessment. Now it is put together and brought into 273, whereby what they have to do in a faceless procedure. I mean, what is the steps that they have to follow, who has to issue what. All the proceedings are now faceless, nothing big different. So personal hearing and a small point of caution here. How many of you have requested for VC and attended a virtual hearing, video conferencing? During at what stage? Sorry, I am not able to hear. Show cause notice, final stage. Only at the final stage. How many of us know there is no such provision which restricts VC only at the final stage? No, you can request the VC at the start itself. There is no restriction on the section. But does the e-proceeding portal allow? The answer is no. Why? Don't you think it is violation of justice? That's what I am saying. The portal is framed in such a manner which is not allowed by the law. The law does not mandate it. You ask for a VC, VC should be given. You ask for a particular timeline, the timeline, if it is within the section, it should be granted. You know, how many of us know, I don't know if anybody have done all these kind of comparisons. You know the ITR forms, right? Basic ITR forms. They get notified by way of a government GO, right? I mean in the parliament. There is a circular number, notification, whatever. And there is a PDF which will come, which is the ITR form, right? Have you compared this PDF and the software? Verbatim, column wise, section wise, tab wise. Why? I mean, I am just surprised by looking at this, because how many of us use softwares, by the way? Third party softwares. Just a raise of hand. Third party softwares. How many of you use income tax own softwares? Wonderful. Now, do we all know the third party softwares are developed based on the income tax utility, correct? Now what I am trying to say, the income tax utility itself is different from what is there in the PDF notified ITR form. I can give multiple examples. There are so many such kind of examples. What is not there in the ITR form will be questions as mandatory questions here in the ITR utility, which is not the information sought there. Can the utility be used for this collection of information? Don't you think this is information? A simple example I'll give. Recently we had a case on that as well. There is expiry of CGAs, right? You don't use the CGAs beyond 3 years, it becomes capital gain in the year of expiry, that whatever. In the year of expiry, it becomes capital gain, right? Now, if you go try filling the ITR to tax this expiry of CGAs, it will ask date of transfer. What is transfer here? Is expiry of CGAs a date of transfer? But without you filling that column, ITR won't accept. The moment you give date of transfer, you imagine what all you are opening up. There is no asset at the first place. CGAs is not an asset. There is no capital asset, there is no transfer. No, what I have to fill as transfer, date of transfer. Now, this is not there in the notified ITR form, but it is part of a compulsory column in the ITR utility. Now, these are just an example. Likewise, you have everything in many forms. In the tax audit report, in the audit reports, we have these issues. Now, these sort of comparisons are very important because it is that information which is being used in the assessment saying you have disclosed this, but you have not done this, therefore I have information to make an assessment against you. Now, imagine the plight. They themselves are opening the trap. We comfortably fall in the trap. The same prey is being used to use it against us. So, be careful about that because it is all faceless now. That's why I gave an example of the ITR utility. This is the search which I am not trying to cover. Again, the old concept of block. That is the only big change as far as the search assessment is concerned. Like in the earlier regime, we had a block period of 6 years plus the year of search. The same thing is now rebrought in the new 2025 Act as well. So, that is the search assessment, but the information as far as the search assessment, that part I am not getting into because that is a wide topic, requires a separate, altogether separate session. So, I am not touching on this. This is the simplified time limit on the comparison. What was earlier, what is now. 3 months as far as a notice under 143.2. 143.2 is to make a regular scrutiny assessment, not your 143.1. The same 3 months is still there in the new act also, nothing big different. Similarly, on the 153, 9 months was the earlier section, now it is extended to 12 months from the end of the financial year of the notice, I mean the return in which it is filed. And then the reassessment, earlier it was 3 years, now it is 4 years, extended by 1 year. But for reassessment for information greater than 50 lakhs, large assessments, they have reduced it from 10 to 6, reduced by 4 years. So, that is the provision. There is moratorium for reopening. Moratorium is a word that I have used here. There is no such word in the Act. The point why I am using it as a moratorium is because they give a leeway. You are given one full year time to clarify his doubt, because his doubt is I have information suggesting income has escaped assessment, right. Now, the issues like what is income, whether that is income which is within the meaning of section 147, all those are separate issues. I am not coming there. If time permits, we will discuss later because we are running short of time, another 10-15 minutes max. So, rectification again 4 years, it is still the same 4 years in the new act also. Search, earlier it was just the regular assessments in the old act, I mean prior to the removal of the block assessments. Now, it is block assessment, separate timelines are there, which is nothing but 6 years prior to the year of search and the year of search. So, total 6 plus 1, 7. 6 will be block, 7th year will be a separate assessment. That block has been brought back again. This is again a summary digest of what was done before. I have just put up a most important change. Now, the game changer is the block assessment, as I told before, because 60% tax rate has been made compulsory in all the disclosures in search assessment. Faceless assessment, it is all the same, nothing different, it is pro assessee. High value reassessment, yeah, reduced from 10 years to 6 years. But of course, we have small intricacies whereby, like I gave an example of 139.8A plus the assessment timeline, we have a longer timeline. VDS, new power which the department has enacted in the new act. VDS, I mean they are amending to include everything. There is a separate definition for VDS which wants to include all sorts of cloud information. Imagine cloud information. How many of you back up all your files? Your phone, your automatically backs up, no? The moment you set up a phone, how many of us read instructions, terms and conditions? Anybody? Accept, 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 accept. Finished. Now, automatically all that information is saved in your Gmail or cloud or your MS Office, wherever. Now, all that information is part of the information that the department can access. That is the power of VDS, the definition of VDS. Now, imagine that sort of a let's say you had a conversation with the client on tax planning. Sir, please do this, sir. You will save tax, sir. Now, the same piece of information, 5 years later, they pick this up and say, you gave a wrong advice. You helped the client in evading tax. Isn't that possible? Yes? No? So, beware of what you are communicating. Whatever you are doing is now you are leaving an electronic trail. Like just an audit trail. It was just an audit trail for that year's audit. Now, this is a permanent trail. You can never delete it. So, beware of what you give as an electronic trail. That's a game changer as well as a new power which the department has got. And then the reopening window, I'm not there. So, this is the PY, quick reckoner about what is on the assessment part alone, because I was initially invited for computational sections, which I was not very specific because it's all the same, nothing big different as far as the computational sections are concerned. I wanted to address specifically an assessment because that is where we as professionals leave a large gap. This is where the entire appellate, the change in the appellate forums comes here because we don't take care of the assessment properly. If you do the assessment properly, today's the pendency of appeals will not be there. There's so much pendency of appeal is because the assessment is not taken care at all. It is either unresponded, not responded, partially responded. It is never responded to in full depth. That's the reason why I specifically demanded that I want to present this. So, there's something called a digital survey, digital search. Again, based on your VDS only. That information is information based on which I can come and knock your door. Saying I have electronic information, you have transacted this, you have transacted that. I can do all the encoding that this. How many of you think WhatsApp is encrypted? It says encrypted end to end. But do you know income tax has access to it? Just give an example. There's so many examples like that. WhatsApp is accessible. If you specifically, if you don't want me to believe, just then go home. Please uninstall your WhatsApp, reinstall. Terms and conditions will come. Please read through. It is one 20-page documentation which will specifically say, if required, encrypted information needs to be handed over to the government authorities. That is the extent of terms and conditions and importance as to whose information can be shared where. All these clouds, for that matter, email, for that matter, your chatbots, your Telegram, any apps that you use, all these apps have these terms and conditions. So, beware of the digital search, digital survey. We only have heard of digital arrest. Now, imagine if this digital information is being used, what all they can do now. Please be aware of that because these are all, inputs. They are all feeds for the department for making an assessment. So, be careful of it. Be careful of the tax planning. So, this is what has effectively not changed, which are the majority of things have not changed for that matter. Small changes like I have told before, nothing big has changed. Right to natural justice, it is there. Like I told before, please demand for VC if you want to explain the case prior-handedly. Do not wait for the tab to open. I just sent a reply today this morning. The portal had some issues. Today was the last date for responding to the show cause notice. The portal didn't work. Then what you will simply do, you will simply say response not received. Therefore, I am proceeding the assessment order. I simply served an email on the assessing officer, took a screenshot of the portal not working. Your portal is not working, but here is the information that I want to give against your show cause notice. This communication in email may be treated as a valid response to the notice because your portal is not working. The same entire email was sent to the the assessing officer. It was sent to the client. This email was printed. Covering letter was done. Went and filed in the ask. Finished. Job done. Now you can always say, sir, it is a faceless assessment, sir. What will the tapal in ask do, sir? I am not bothered. You only amended the section to say faceless and jurisdictional officer are one and the same. I filed it before the AO because portal did not work. What will I do? This is the extent of practicality that we need to approach while approaching, because as we approach into a digital era, even the portals do face challenges, right? They also have downtimes. They also will not work. We have to gauge all that and then accordingly act, because otherwise if you don't reply, it will get on to a different problem. So, beware of careful surveys or replies to the notice. So, burden of proof, settled case laws are still applicable. Writ jurisdiction of high courts, completely unaffected. Similarly is the appeals before 260A and the Supreme Court appeals. All those are not amended. DRP route is still there. Please be aware, DRP today, everywhere where there is a non-resident or a TP case, DRP comes into picture. Do you know what a non-resident when DRP can apply? I mean, how many of us know that just because you go and change the status as non-resident or resident, just in the portal, if you go edit your profile, you can change non-resident, resident, right? Will that alone suffice? The answer is no. You will have to file an amendment in PAN application, tell them that I have become a non-resident. That is when the jurisdiction of the particular assessee can be transferred to a international taxation officer. Otherwise, it cannot be transferred. What happens in many cases is that by wrong information in the PAN application, PAN would be sitting with the international taxation officer. For all you know, that client would have never boarded a flight at all. He would have been here in Chennai. He will receive notice from international taxation officer. Now he will have to undergo all the DRP proceedings. Imagine the quantum of work that is involved. So please be aware of all the small consequences, because if you don't object it at the start, then you will never be able to object it, because DRP comes into a very limited set of situations and scenarios and not in every place. I had an interesting case where an HUF got a notice from an international taxation officer. How can a HUF get a notice from an international taxation officer? Anybody aware of how a residency status can be determined for an HUF? Huh? No, not Karta. There is something called POEM under Income Tax Act, place of effective management, right? The same POEM provisions are used in HUF also under section 6 to determine the status of an HUF. There is a separate proceeding for that, by the way. Without doing all that, the officer goes ahead and issues 148 notice on the non-resident HUF. The High Court had quashed. We won the appeal. Of course, it took about 1.5 years time, but we still didn't win the appeal because the jurisdiction failed. The AO did not have power at all. Where is the question of making an assessment? So that is the extent of small intricacies coming into the root of the matter. So this is the practical issues, grey areas. Earlier timelines and new timelines are captured. So the scrutiny pending is something that I want to capture here. The last of the scrutiny is, what was the last income, what was the last assessment? Now, do you all know what the breakup is between when I can initiate under a new proceeding, when I can initiate under old proceeding? Anybody? Let's assume I have some information about, let's say, assessment year 24-25. I find that information only now, just now. Where will I initiate the proceeding? In the old act. Now, till when you can invoke such a kind of action under the old act? Will you apply the timelines under the new act or the timelines under the old act? Old act. Now, the answer is very clear, because there is no saving or saving clause under the new act. There is no transitional clause. There is no saving clause or repletion clause, meaning there is no deletion clause effectively to say that effective this period all proceedings will be shifted under the new act. Now let's assume, let me put it this way, let's say there is a pending assessment initiated prior to 31/3/2026, but I am completing the notice, I am completing the assessment now, obviously under the old provisions. Now where will you initiate the penalty proceedings? Why? Is not penalty a separate proceeding from assessment? Any answers? Penalty and assessment are two different topics. Or let's even forget penalty. Let's talk about prosecution. The new act also talks about prosecution. Now, will I prosecute you under the new act or will I prosecute you under the old act? These are the specific exceptions which certain sections have in the new act, although they are not relating to assessment, but certain sections have this kind of a reference there. Now, in any penalty case, barring certain penalty sections like 271G, 271D, which are procedural penalties, like violation in 269SS, 269ST, non-filing of tax audit report, 271B, non-filing of TP report, these are all procedural penalties. Now, this always you can initiate under the old act. Now, imagine a penalty like 270A, an assessment penalty, meaning differences in income. The penalty section uses the word during the course of the proceeding during which the difference in income was found out, correct? Now you initiated the proceeding under the old act. You completed the proceeding during the new act using the powers of the old act. Now the penalty sections uses the word during the course of which such concealed income or such difference in income for which penalty has to be initiated is to be drawn. Now cannot the penalty be initiated under both sections? The answer is still open. Even I don't have an answer. Because the proceeding conducted and far reached beyond 31/3/2026, though under the old act. My old act had very limited penalty provisions. My new act is having rigorous penalty provisions. Now, can the assessing officer still say that the proceeding concluded post 31/3/2026 and I passed the order under the new regime? Therefore, I can still initiate a penalty proceeding under the new act. I mean, which we need to look into. These are all not there in the statute. These are all part of the judgments, because the judgments simply say during the course of which the assessment you found something for which a penalty is to be initiated. That is the basis at which I am asking this question. There are so many such questions actually. This is the transitional era, meaning procedural assessments are very easy. Now these sort of issues which are still not answered. Let's talk about trust renewals. You filed renewals under the old act. That might be valid for, let's say, assessment year or year ending 31/3/2027. Now let's stay under the new act. If you file a fresh application, should it be given from 1/4/2026 or from 1/4/2027? These sort of transitional issues are still not answered in the new act. Let's wait for more clarification in circulars. That's when we'll be able to know all this. So that is the transitional scenarios. Pending appeals, of course, whatever was filed under the old act will continue under the old act, which are very specific. Search conducted, that is the block, that is the date on which the search last will be there, effective under the new act, under the old act. These are some open questions under the 2025 act, something that I was just discussing about. VDS constitutional, can AO access personal WhatsApp without specific warrant? Because there are sections saying you should give a warrant for accessing any private information. Now without a warrant, just because VDS is defined, can someone come and say, boss, please give me your WhatsApp chat, I want to take backup of everything and I want to encrypt, decrypt it and I want to use information from there. Can the AO do that? So moratorium. The question that we were discussing, whether moratorium of 1 year inquiry period applies to updated returns filed under 139(8)(a). Whether 8A returns will still have this 1 year time period or the old 3 month time period. Interesting question. Because if I have the 1 year period, I will have a long time to substantiate my claim. My 3 months time is very limited. Faceless exclusions, what will be excluded, whether search, what all will be excluded. I was just telling about, assessing officer sitting with the DG office, Director General office, assessing officer sitting with the black money office, the Foreign Asset Disclosure Act, all those are separate officers. They are income tax officers, but they are empowered to do only assessments there. Now, do they also fall under the faceless regime or they will still be under the manual regime? These are yet to be clarified under the new act. Then split tier residence, that is a separate rule which we are awaiting notification. There is the quick mapping reference which I was talking about. Please have something like that. Like even during Uttam sir session, TDS is very, very, very procedural dry subject. There was a wonderful mapping which he had created. Imagine all sorts of our officers have this mapping in our circular or in a notice board. Whereby every day as people go and come and see, they'll be able to easily get past that new section number or the form numbers. So these are the most important things to take home after the session. Sorry, I'm running a little late by 5-10 minutes as I was given late. So the master the section mapping now. Day by day you can easily map if the following steps can be done. If you have a simple mapping table, then it is very easy. Digital practice, like I told you, please start practicing yourself to have digital, rather I would say digital discipline. Like how we had financial discipline, we need to have digital discipline. What we need to discuss digitally, what we need to discuss in person, what we need to share by email, not by email. Please be aware of it. In the urge of doing some work, please don't give away all your information because all those are source of informations. Reassessment, the timeline changes. Search cases, now again a fundamental shift back to block And then the VDS. VDS is a new challenge that we all have. Be very careful. Like I told before, all the case laws, all the landmark judgments on the earlier 61 Act will still prevail. We are still having 22 Act judgments still applied. How is that possible? That's the extent of transition that we have. The same principles are there. Nothing differed. Earlier section 22 under the 22 Act is now the new 148, is now the new 281. The intentions are same. So the judgments are all the same. They don't undergo a change. These are some open debates for the on floor. Yeah, this is the closing thought. So I will quickly want to close here. Anybody on these quick little questions? Imagine the 4 or the 6 year cap. Now they are simply saying for high value transactions exceeding, second question. Okay, first I don't want to dwell more because that's a large topic. Second one, for cases less than 50 lakhs, they are increasing the timeline for reopening from 3 to 4. Right? But for cases beyond 50 lakhs, they are reducing it from 10 to 6. Don't you think this will increase the extent of cases coming under reopening? Because less than 50 lakhs, there will be so much information under AAS, TAS, faceless collection, your VDS, that, this, etc. Left, right, center, you will have information. Now, all those information, if it is not getting reconciled and filed in your ITR, imagine the scope of reopening notices that you are going to have. That's a huge set of debate. So, advance objections for pending proceedings under the new Act or the old Act. Some interesting questions like I was just discussing. What is the transition? Where is the transition provisions covered? Will penalty come under the new Act? Will prosecution come under the new Act? Will it be under the old Act? Last question, interesting something for our CA practice. Should we all be very careful on saving client information merely because VDS is there? Because ours is also VDS. They can simply give you a warrant to access some client information and come and check all your cloud. Possible? Yes, right? So, should we not be gearing up ourselves to carefully mitigate our risks in the storing our client data? Be very careful about it. So, like I told before, it's not a revolution, it's an evolution. Evolution includes revolution. That's what is a new act, to be put precisely in short forms. There is no big changes like I told before. It's just the different form numbers, different sections. The substance is all the same, nothing different. It's just the old proverb of saying new wine in old bottle. Simple, nothing else. Because the sections have not undergone any drastic changes, but for here and there small changes. So with this, I would want to close now. Thank you. Anybody has doubts? We are open for another 5 minutes maybe at the max. Any questions? I am open to answer. Transition. Assessment year 26-27 won't be applied, sir. Won't be applied. It's for the relevant tax year. Tax year is the point where this particular issue will come. So, belated tax audit report filing. See, that is the intention. That is what you can look at. See, sitting at the podium, I don't want to talk ill about the ongoing government. But as you know, all the provisions, if you look forward today, everywhere there is late fee. Late fee, or late filing interest. They are all simply collecting on late filing fee. Imagine MCA forms. Imagine our TDS return forms. Per day 100 rupees. Imagine the plight of it. Now, every act is now started to bring this. Now, imagine this is a precondition for you to file the return. You don't pay the late fee, you are not allowed to file. Earlier it was not so. Earlier it was a penal provision. There is something called a compensatory provision. There is something called a penal provision. Why is this separate distinction? Is because I compensate, I wantedly, belatedly filed something. There was a loss to the government or loss to the exchequer. I compensated it by way of an interest or a late interest. But if you are going to obligate something and say, unless you file this late filing fee, you are not going to be allowed to file a return or a form or an audit report. Where are we at? Everywhere it is late fee. You look at the new act, this late fee and all is merely a substitute for your 271B. Correct? Earlier it was 271B, a separate penal proceeding has to be done for you to collect that 1.5 lakhs penalty. But now imagine you don't pay this penalty, you are not allowed to file the report. That is the extent at which we are looking at. So the timelines are very strict now. The systems are made so there is no scope for you making a practice of appealing or principles of natural justice. All these are lost now. So be very careful about the timelines. So assessment 26-27 is not applicable. Anybody else? Any questions? I will have the PPT also to be shared sometime. I mean, we'll check with the conveners. So with this, thank you. Thank you once again. Have a good evening. Thanks for the patience.
Sir, thank you, sir, on behalf of SIRC for taking a time being with us in this evening. And I also thank members for attending this evening and making success. So thank you. We'll be seeing you soon.